Hello everyone, good afternoon, and welcome to this refresher course on Companies Act 2013, specifically focused on some important concepts of auditing. Uh, in the event we are about to kickstart an entire audit season, a lot of companies, listed companies have already come out with their disclosures with all of the requirements. But now it would be time when we are discussing private companies, and we'll be doing a lot of work in terms of auditing. And therefore, given the need of the hour, at WIRC, we thought let's bring in some critical aspects of Companies Act which are relevant for auditing. And therefore, we have brought out this session with some wonderful speakers, great faculties who have done a lot of research on these. In fact, not only Companies Act, but each and every section of Companies Act. And therefore we've tried to bring out something important so that we could do value add in our auditing exercises. So I welcome the chairman, CM Murtuza Kachwala. Before we begin, may I request all of you to please put your hands on your heart for the ICI motto song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
Right, good afternoon once again, welcome. At the outset, I really apologize for the delay start. I think 5 minutes that we are delayed. We are joined with our first faculty, Aleem Lilani, here with us. I also welcome the coordinator, CA Bhavna Radeshwar. Before we could go ahead, first of all, congratulations. We've had a wonderful regional council in Pune. I think the entire WIRC, we did a lot of work, value add in terms of future readiness. And we had a very successful conference. Coming up next is the DTRC, the flagship program of WIRC. I would request everyone, and I would request the chairman to please address and please share light on the upcoming DTRC to all the audience. Over to you, chairman.
Thank you, Arpit. A very warm good evening to all the participants. I can see almost 200. So thank you very much for joining in, and really grateful. The registration is much higher and I'm sure people will join in. Let me first congratulate C. Arpit Kabra for organizing such a splendid program at the right time. The audit season is just starting, and he is like dynamically and aggressively planning so many good stuff. So thank you, Arpit, for all the good work. Let me also welcome C. Aleem Lilani and Amit, both the speakers for today. Aleem, thank you very much, and Amit was also here. Amit, extremely grateful for sharing your valuable time with all the participants and sharing the knowledge. And let me also thank Bhavna, the coordinator, again for supporting us in the WRC activities. Thank you, Bhavna. So the theme this year at WIRC is LEAD, that is Leap Towards Excellence, Achievement and Development. And we have identified and listed down 5 goals, and against each of the goals multiple activities and measurable criteria to ensure that we deliver what we planned. And when we talk about the first goal, so that is updating technical knowledge of members. And here we want to work on both the fronts. So of course, one is the traditional areas like the company law. If audits are required to be done, we'll need to cover the CARO, changes in CARO, the changes in the Companies Act, and the relevant pieces so that members are equipped. Similarly, we also did one refresher course on standard and auditing. We've done one on accounting standards. We've done one on Ind AS. We are also planning something on the whole IFRS and the other gaps, because there are a lot of shared service centers which are coming up and people need to adopt those various gaps on the accounts for multiple countries which they do sitting here in India, in Pune, Bangalore, etc. And the DTRC, the Direct Tax Refresher course, which is our flagship event. And again, there we got the best of best speakers, and it is going to be on 4 Saturdays and 8 hours. So like every Saturday, 3 hours, total 8 different topics on direct tax, and the best of faculties in the country today are going to be speaking on. The program is physical at BKC in the auditorium starting on next Saturday, 18th, then 25th, and then 2nd and 9th. So I would request everyone to join that as well. In addition to that, at WIRC, we are also planning various refresher series on internal audit. Is going to start immediately in about 2 weeks time. One on international tax is again starting simultaneously, and we are planning refresher courses on opportunities in cooperative, insolvency, in bankruptcy, and we want to make it hands-on. So what are the assignments? Where do we get empaneled? How do you do the work? What is the type of fees that you can recover? So all of those we want to cover in those 12, 15, 18 hours, whatever we plan in those particular subjects from the refresher courses. In addition to that, multiple courses on technology, but let me only touch upon one. So on technology, we also started a longer duration course. Part 1 is of 60 hours, which talks about automation using Python and SQL. And it is done on a Saturday evening and a Sunday morning. And 60 hours hands-on with live data on procure to pay, order to cash, calculation of interest, commission, etc. for the fee as low as 9,000 rupees for members. And the part 2, we already done 4 batches of part 1 with 30 participants each. Excellent feedback. The 5th batch is going on right now. Part 2 is visualization with Tableau and Power BI. We completed 3 batches. The 4th batch is going on. And that is again only 6,000 rupees for 40 hours. And we also combine both this part 1 and part 2 into a 100-hour course for CS students for as low as 5,000 rupees. And believe me, if you go out, this will be more than 1 lakh rupees. So I request everyone to take part in all these technology courses and upskill ourselves so that we are ready to face the future with confidence. With that, thank you very much. Happy learning. Again, a big thank you to Arpit for organizing this program, and over to you, Arpit. Thank you.
Thank you, Murtuza. Thank you for sharing these updates. I think some relevant updates, because most of the times we hear from participants that we don't even get to know what is happening at WRC. I think these events are marquee events, which I think through these programs we can share with all of them, because I think we get so many of emails from everywhere. Probably there is a huge, I would say, a blast of communication across. So probably these things may get missed. So thank you, Murtuza, for creating these relevant conversations. So now coming back to our session today, section 184, 185 dealing with directors, 186 loans and investments by companies. I think one of the most critical aspect if we are auditing, where are these loans, where are these investments, and are they in the nature of diversion, are they in the nature of anything else? And 188, one of the most hot topics, related parties, now substituted very aptly by connected parties of 29A of IBC. I think this has made the audits very robust. To talk about all of these particular sections of Companies Act, we've got faculty Aleem, Lilani. I will request coordinator and I welcome Sharon Sangvi to please introduce Aleem quickly so that we can start with the session. Over to you, Sharon.
Yeah, hello. Thank you, Arpit sir. Am I audible? Yeah, fine. Yeah, thank you. Yeah, first of all, good evening, everyone. It's a wonderful afternoon itself, and we are again meeting. I think I'm meeting Arpit sir after a whole long time back. So it's great meeting to all of you. Also, Murtuza sir, thanks for organizing such a great event. So without taking much time, I would just introduce our today's faculty, CA Aleem Lilani sir. He is director in MSK and Associates, and his area of expertise includes statutory, tax audit, and certification services, also quality assurance and risk management. Talking about his professional synopsis, I would say he has over 15 years of varied experience in providing audit and assurance services to clients and handling quality assurance and risk management for the audit and assurance practice. His experience and expertise also includes guiding the audit teams on implementation and interpretation of Indian GAAP, certification, financial statement reviews, conducting cold reviews, also guiding the audit teams for the standardization and circulation of audit, review, certification, work paper formats. Also, his expertise include training and development for imparting various trainings on implementation of audit tools, auditing standards, Indian GAAPs, Ind AS, IFRS, and his other expertise include expert opinions to client, assurance services to capital market transactions, etc. So without making further time, and I would like to hand over to CA Aleem Lilani sir to please proceed further. Thank you, sir.
Thank you, Sharon. Thank you, Sharon. Over to you, Aleem bhai. It's revisiting our old Hari Bhakti days. So 188 is what we'll typically look forward to. I think one of the most critical sessions. So over to you, sir.
Thank you, Arpit. Been a long time. Good to see you. And you're doing a lot of work in the institute. And congratulations to you on that front. Yes, we did work together. It was a great time during our initial learning days. And now it's time to impart to the world whatever we have learned. So it's my great honor to be here to share my knowledge with all of you. And today's topics, as respected Murtuza sir also is here, we have been on other platforms, and today's topic is one which pinches the client. It is the section that deal with him running the company, and that's the reason why we need to today weigh fairness from the company's point of view as well, and then come to what auditors have to do, because these sections are primarily to be adhered to by the client. So what my agenda today would be is to give a brief overview on these sections. Let's try to understand why these sections are in place. I think if we are clear about how these sections operate and how the law has been drafted, or let's go behind the curtain, behind the law, it would be easier to appreciate the the cumbersomeness of the section, which mandates you to go through so many resolutions and so many approvals. And sometimes it is irritating that why do we have to go through so many. But I think today let's take a step back and try to understand these sections, from where they are coming, why they are coming, and let's not be afraid of them. Let's face them hand on hand, face on face, and let's see how we can get behind the curtain on them and stay ahead of them rather than becoming default in these sections. All right, so let's begin with so I have 4 sections today to cover, and I have approximately a time of 1 hour. So I'll touch upon the section itself because we need to refresh, and then we'll take up some kind of discussions or like maybe case studies, and we'll take a question answer session later. Okay, now the first section, section 184 of the Companies Act, which deals with disclosure of interest by directors. Now, I would like to take a moment here to tell you what this section, what the reason of this section is. So the section does not say that you cannot do transactions with your directors or their relatives or in companies where directors are interested. That is not the intention of this section. So there's nothing to be afraid of. But the section or the intent of the Companies Act is to have fairness in operations of the company. So to enhance the fairness, there needs to be a disclosure. So every director that comes on board needs to first disclose where his interests lie, and he should not be voting on that transaction. That's also fair, because if he starts voting on that transaction, it would become a conflict of interest. So section is very beautifully drafted. Every director comes on board, makes his disclosure. Every board meeting, he comes and updates his disclosure, and the board also recognizes that so-and-so person is linked with so-and-so relatives, companies. They take cognizance of that fact and then take the contract which they are seeking. So if you look at the act, the way it is built, the section, we'll read it in some time. It is very, very logically drafted. Okay, so let's go through it a little bit and then we'll talk. So 194.1 is a general disclosure clause. That means every director coming on board should have a process where he comes the first board meeting he attends, he tells where I am interested. So the section specifically says that every director shall disclose his concern or interest in any company or companies or body corporates or firms or other association of individuals, which shall include the Shareholding Act. So he has to disclose his association and the shareholding at every first meeting of the board where he participates as a director. So the first time he comes on board, every financial year's first meeting, okay, first board meeting of every financial year, you need to again disclose, okay. And first meeting of the board held after there is a change made in any previous disclosure already made by the director. The 184.1 is very, very clear that any change happening, please come and disclose. Every time, every year, please come and disclose. One important point to note here is very practical, that if a disclosure has been made by a director at one meeting, that disclosure is null and void at the end of the financial year. He has to make it again. Okay. In all fairness, I would say it's a good practice because you get to replenish your list every year mandatorily as per law, which is a very good thing. But that everyone has to keep in mind, especially the private companies who many times feel that once it is done, it is done. No, it has to be done every year. So even if he came in March month and made a disclosure and your board meeting is next in April, he has to make the disclosure again in the next month. It will not be void, it will not be valid after 31st March. So that's one, general disclosure. You come on board, you make disclosure. Second, specific disclosure. Now, if any director learns of his interest in any contract, okay, with a body corporate in which he is associated, or with any other director he holds more than 2%, or he is a promoter, manager, CEO of that body corporate, then he has to disclose his interest. So this is a specific disclosure. When the contract is brought on the table, he learns of it, he has to make the disclosure. And second, he has to disclose his interest with any firm or other entity in which such director is a partner, owner, or member, as the case may be, which shall disclose the nature of his concern or interest at the meeting of the board in which the contract or the arrangement is being discussed, and he shall not participate in the meeting. So two things are very clear here. There is either a contract in place or it is being proposed, and director has now come on meeting on board. He has to make the specific disclosure that in this contract I have an interest, and board has to vote on the contract after considering his disclosure. Okay, and he cannot vote on that resolution. Very fair, very well written clause. No ambiguity in this whatsoever, actually. Now, in public companies, normally it is a public company where a person can hold shares easily. Where if it is less than 2%, there is no concern. There is no disclosure required. You can go ahead and have the contract. If the holding exceeds 2%, then in the next meeting, he will have to disclose that my holding has exceeded 2%. I am interested in this contract. Please reconsider. Then the board can choose to reconsider. So I want to draw attention to the second part. He also has to disclose any relationship with a firm or other entity. So it could be any entity whatsoever. And he has to disclose his nature of his concern or interest. That means he needs to bring out very specifically what he is going to benefit, what is his role in that other entity. So it does not mean only shareholding, it does not mean no shareholding but voting power. Whatever his concern or interest is, he has to bring it out in that meeting. So let's go very conceptually. In case of body corporates, he has to disclose his holding and his role either with some other person as a promoter, manager, or CEO. And in any other firm or any entity or AOP or anything, he has to disclose his interest there. It can be in any form, participatory, non-participatory, anything. Okay, let's move forward. We'll come to some examples later. How do you make the disclosure? The form MBP1, it needs to be submitted by directors for disclosing his interest. There's a form, there's a format prescribed. The director has to simply fill out that format and submit it to the company. Very simple. All the disclosures are required to be kept at the registered office of the company. And as these are documents of a company, of course, they need to be preserved for 8 years from the end of the financial year to which it relates. At least that is the minimum period it should be kept for. Any contract or arrangement entered by the company without receiving the disclosure from the interest by director, who is actually interested in that transaction directly or indirectly, okay, it shall be voidable at the option of the company. This is the reason why this clause is very important. Company can straight away consider it to be void. Okay. And the further provisions which I have not written here is that the company can ask that director who is interested to be liable to indemnify the company. And if any case or any proceeding is initiated against the company, that director will have to face it, not the company. So these clauses make it very, very important for a director to not miss this kind of a arrangement or disclosure of arrangement. If you look at the penalty as a way, director's penalty may extend is imprisonment for 1 year or fine up to 1 lakh or with both, which are also very severe. So the reason why this clause becomes very important is because the company can make it void. The director has to indemnify the company, and any case going on, that you'll have to face it. So these are the reasons why this section is very important, that it should be complied with. Okay, so it's a repeat of that slide. Okay. Some other important points that you need to take care. Director should update not only his appointment in new companies, but he should also update relinquishment of his office or post in other companies. So this is something that is very much missed out. So in every board meeting, actually, if you really need to comply with this, you must have an first agenda point, take on board director's interest. That should be the first agenda point. If that is the first agenda point, this clause will never be in non-compliance. So every director is forced to come up and give his disclosure. So invariably, he will give his disclosure even on the contract on hand being discussed in the meeting. Then the management can also circulate regularly inquiries with the directors so that they keep responding back with their disclosures. So company is never in non-compliance of this clause, and they are aware before they pursue contracts that these contracts have how certain directors who are related, who are interested. The next point, as I discussed, that the notice expires at the end of every financial year, needs to be afresh annually. And the purpose of this clause is again not to restrict any transaction. So it is not that you cannot have transaction. You can definitely have the transaction, just that you need to have the disclosure. So if you ask me, this clause is rather very simple because it is purely a disclosure clause. It is nowhere barring any director from bringing business to the table. Neither it is barring the company from having business with directors and their relatives. So this clause is very transparent. Many people have the wrong notion that 185 is something really going wrong. It's nothing wrong. It's just a disclosure clause which needs to be adhered to. It does not prohibit business practice. Again. So this is one of the very key points that you can take from this clause. Of course, as auditors, we do tell our clients, oh no, there is a violation of 184. But the fact is that it is more for promoting fairness and not for anything unlawful. Okay, so that's a fairly short clause. Coming to one of the other most important clause is 185. 185 is a clause that deals with loans being given to directors. Now, this has been a topic of discussion for ages. Everybody is concerned that as soon as the company is made, money gets parked with the director. So this clause was brought in to catch that activity. So the first clause itself first lays down that you cannot give Okay, so no company shall directly or indirectly advance any loan, including loan by way of book debt, or give a guarantee or provide a security in connection with any loan taken by director of the company or the company or of a company which is the holding company. So you cannot give a loan to director of the holding company also, or any partner or relative of such director. That means the director's partner or relative also cannot get the loan. And any firm where such director is a relative or director or the relative is a partner, so that firm is also caught in the web. So this is a very straightforward clause. Companies Act does not allow it. Going forward, company may advance loan, including the book debt or guarantee or security, taken by any person in whom any of the director of the company is interested, only if special resolution is passed by company in general meeting and loans are utilized by borrowing company for its business activities. So now we have a case where it is allowed. Where is it allowed? Pass a special resolution, give the loan, no problem. But that loan is to be given to that person or entity only if it is being used for his principal business activities. This is something that should be documented. It is difficult because when you have it should be in the contract when you give the loan, why you are giving the loan and what is the purpose of that loan. That needs to come into the contract. And as auditors, when we evaluate these contracts, we should see that that person is taking the money for his principal business activity, not with activities on the side, but the main principal business of that company. Again, understanding that it's not prohibited to give the loan, but again, if you pass a special resolution, there is an okay from every shareholder. So 78% of shareholders. So it's okay. Company can go forward because we have approval. Now, who are exempt? Managing director, whole-time director are exempt. When if you give loans to them, it's fine. If it is part of the conditions of service extended by the company to all its employees, or it is as per any scheme approved by the members by a special resolution. Again, coming to the fairness of the whole clause, if anything is approved by special resolution, it is fine. We can give the money or loan to those persons. So MD, whole-time director are mostly out of the net. You need to go and check, are they receiving any remuneration or money besides this to allowed matters. If they are receiving something other than this, that transaction is caught in this web and should not be allowed or will need a resolution. Now, the second most important thing is that the company which is in the ordinary course of business provides loans or gives guarantee or security for due repayment of loan in the ordinary course of business, provided the interest rate is not less than the bank interest rate. So you have to give these loans, but you cannot give it at less than the interest rate charged by the bank for the government securities. Okay. Any loan made or guarantee given by a security or security provided by holding company to the wholly owned subsidiary is exempt. Okay. So I've anytime had this question come to me because it is very normal for a company to take loan from one bank and then fund its subsidiary. Okay. And this transaction does not come under the net of 186. So a company is free to take loans and fund its wholly owned subsidiary again or give guarantee. In case of the subsidiary which is not wholly owned, you can do it only, you can only give a guarantee. Okay, you cannot give a loan. If my wholly owned subsidiary, I can give a loan, guarantee, security. If it is my only a subsidiary, I can only give guarantee and security, no loan. Okay, so this is certain little bit they curbed it down. Okay, fine. If it's a subsidiary, give it, but don't give him loan. You can give a guarantee. Okay, and that too, he must use that guarantee in favor of whom we are giving the guarantee and the money is coming in. That money should be used for the principal business activity. This is very, very important. A question does come up, how do we verify the principal business activity? That again, you need to look into the contract. Why was the money required? Why was the agreement executed? Why was the guarantee given? These questions auditors have to ask. Okay. So far very clear. Let's move forward. Now, loan to directors can be given to the director or to any person whom the director is interested. I cannot see the screen. Is my screen? Yeah. So the director or any other person. Now let's talk about who is the other person. The other person to whom in whom the director is interested will include whom? Private company where the director is a director or a member. A body corporate at the AGM, at the general meeting of which not less than 25% of the voting power is exercised by that director or two or more directors together. And a body corporate whose board, managing director, manager is acting as per instructions of the board or the directors of the lending company. So these are the companies to whom you cannot give. Okay. So previously we saw the sections where we cannot give unless it is passed by special resolution and it is used for the principal business activity. Now we will talk about places where 185 is completely exempt. There is no problem in going ahead and giving loans. One, in the private company, but where the share capital, no other body corporate has invested any money. So such a company can give loans. If the borrowing of such company from the banks or the institution or any body corporate is less than twice its paid up capital of 50 crore, whichever is lower. So such a company can go ahead and give the loans. Such a company has no default on repayment of such borrowing at the time of making the transaction under the section. Obviously, if you are defaulting your current loans, you cannot go ahead and give loans to your directors and their relatives. So company has to first look at its own interest and in the national interest of the country. So the next term is very logical. A Niti company, section 8 money. Obviously, the function of the company is to give loans. So 185 is not applicable, provided the loan is given to director or relative in the capacity as a member and the transaction is disclosed in the account by way of a note. Very fair. The business is giving loans, can be given, but it needs to be in the capacity of a member and it should be disclosed in the notes. Similarly, a government company is not restricted from giving loans, provided the company obtains the approval of the central government before making the loan or giving the guarantee or providing the security. Very simple. In case of a specific international financial service center and private companies, they have also been given certain exemptions. I mean, they're not fully allowed, but the requirement has been tweaked to some extent. You'll not get much into them because they normally do not come up. Now, what is the penalty here? Again, we're talking of a loan being given. So if the company gives the loan, the company has a penalty of 5 lakhs to 25 lakhs. If the director is authorizing that loan or is involved, it's coming to him, it's 5 lakhs to 25 lakhs for him as well, plus imprisonment up to 6 months or both. And any other person who is involved in the transaction to whom the money goes, is also fine will be 5 lakhs or 25 lakhs or imprisonment up to 6 months or both. So this clause captures everyone into the net, and a violation of this clause can be very, very expensive for the company. Again, the objective is fairness. So go by fairness, and these things should not come up in a company. So let's talk of some examples, very practical examples. What could happen in this case? Let's say sale of a company flat to a director at the prevailing market price, out of which director pays 50% immediately, and he contracts to pay the balance amount in 10 equal installments. Now, would this be considered a loan to director, the 50%, which he's going to pay in 10 equal installments? So the answer is no, because the flat is being sold to the director. He is purchasing it at the market price, and the what has been extended to him is as per market conditions. So it cannot be considered as a transaction of a loan. But you need to ensure that when you check this, it should not tantamount to unfavorable advantage to him. That will go to next level where we can consider it as a loan. Now the next case, making of a deposit with the landlord under license agreement for securing residential accommodation for managing director of the company. So company is giving deposit to landlord for residential accommodation of the MD. Is this a loan to the director? Again, no, because this is being done by the company for its MD, and it will not be a loan because these are the terms of his employment, right? So we have to look at the contract. We have to look at his terms of employment. And again, that loan, that contract lease agreement is with the company, so it is not with the director. A salary advance of 5 lakh to employee who is the wife of the managing director of the company. Two things to see here is that one, while she is a related party, she is related to the MD of the company, but in what capacity the loan is being given? A salary advance. So salary advance is given in capacity of an employee. So here also we will not consider it to be a transaction of a loan. However, supposing she was not the employee of the company, then definitely this kind of a transaction would be considered under 185. Loan to a firm in which director of the company is a partner. I think you all know the answer to this. It is considered as a transaction of loan. I cannot finance a company or give a loan to a company where my director is a partner. Okay, I'll give everybody a minute to read this. Okay, so ASP Limited is a listed company who secured residential accommodation for the use of its MD by entering into a lease agreement with the landlord. As per the agreement, ASP Limited deposit the sum of 10 lakh rupees as rental advance with the landlord. Referring to the act, decide whether the said amount could be considered as a loan given to the MD. So in accordance with provision section 185, the amount deposited with the landlord under license agreement securing a residential accommodation for the MD of the company cannot be considered as a transaction of loan, as it is the company and not the director who has entered into the transaction. Similar to the earlier clause, it is the company entering into the transaction, not the director. Another case, X is the director of ABC Limited. He has approached the housing finance company for the purpose of obtaining a loan of 50 lakhs to be used for the construction of building his residential house. The loan was sanctioned subject to condition that ABC Limited should provide a guarantee for the repayment of loan installments by Mr. X. Great. I'm sure everyone knows the answer of this. Company is giving guarantee for the director. Guarantee by a company of which Mr. X is the director for repayment of loan interest as per terms of proposed agreement is not allowed because it's a unfair advantage for the company, for the director. So these are very simple case studies. So when we look at the transactions, we must break them down to what the act is asking, and it will be very simple to deduce what is allowed and not allowed. 1 minute. So here are some of the questions which would be some important points which we need to keep in mind when we evaluate the transactions for compliance with 185. Again, section does not prohibit, but you can do it with a special resolution. So if you look at it, you can pass a special resolution and enter into those transactions. Challenge lies in interpreting what part of the activity should be considered as in the process of business. Okay, this is going to be the greatest challenge that we will face, because loans are happening. Now, when a loan happens with a director who in a company where director is interested, you need to go and evaluate what that company is doing, whether that money is going for the principal business activity of the company. So if we pass a special resolution, we can give the loan, but it has to be used for the business activity, the principal business activity of the company. What is the business activity of the company is something we don't know, because the company could be into multiple lines of activities. So what we need to do is, we should look at that company, what is its ordinary business as a going concern entity, means a company that is thriving. What is its ordinary business? Is it sale purchase of commodities, trade, goods? So then we understand, as a going concern, what is its primary business? Money should be going for that activity. So we need to analyze the financial, the operations of that company. The board should analyze it, should document it in the resolution, and then accept a transaction like this. And the notice that goes out to the shareholders should have these details. Who is that entity? What is his business? What does he do? Okay. We should also see this. We can also see the past practices in the earlier so many years. What were they doing as business? This is what will help us catch the loophole in this clause. One other point is, let's say a transaction for supply of goods or property on the credit beyond the normal terms would also tantamount to loan to a related entity where the director is interested. The other part we will see in 188, but in this case, if supply of goods is going on and that entity is getting unfavorable advantages and deferred credit terms, then we can see that as falling under the net of 185. A loan given to an employee who later becomes a director or relative of director. So this prohibition shall not apply at that time, because what we need to see is, before we give the loan, whether he was a director or a relative of a director. So in this case, since he is a loan given to an employee who later became director, it is fine. The prohibition does not apply. Okay, section 186 now. So that was all about 185. 185 dealt with loans completely, only to directors. Now we come another step forward: loan by companies and investment by the company. This is a very fair clause that has been brought in. I'll come to this a little later. So loan and investment by a company, the straightaway provision of this law says that there are two parts. Without prejudice to provisions contained in this act, company shall, unless otherwise prescribed, not make investment through more than 2 layers of investment companies. Okay, so I am the holding company. I can invest in one subsidiary, which is an investment company, and one more subsidiary, which is an investment company, but it cannot go down to a third one. The reason being, the company wanted to capture, wanted more to bring more transparency in operations of a group, because what was happening hitherto was that people were routing money into multiple SPVs with companies not having any operations whatsoever. They were just investment shell companies, and money was being routed through various countries, through various channels outside, where it would not be possible for anyone to trace the whereabouts of that money. So from this clause, you understand is, you are allowed to invest, but an investment company should not go below 2 layers. What is an investment company is the first question now. The investment company means a company whose the principal business is acquisition of shares, debentures, or securities. And company will be deemed to be principally engaged in business acquisition of shares, debentures, securities if assets in form of investment, shares, debentures, or securities is not less than 50%, or again it is or, Income derived from the investment business constitutes not less than 50% as a proportion of its gross income. Very simple definition to break it down for you. If 50% of your assets and 50% of your income is related to investing activities, it is an investment company. That means there is no tangible operations in that company. It is more a financing company used to finance further investments. Investment can be not only equity, it can be debentures as well. Keep that in mind. Now, what is the exemption? If a company has been, if we acquire a company outside India as an investment company, and in their company law they need to have more layers of subsidiaries, it's fine. Okay. Or a subsidiary company which is having an investment subsidiary for purpose of meeting requirements of any law, that's also fine. So basically, any law within the country which needs investment in multiple layers, or laws of countries outside India which need multiple layers, fine, no problem. The investments can go into multiple layers. But I would say this captures within India, and the Indian laws where it is not allowed, you cannot go down beyond 2 layers whether you are making any kind of company. So this is a simple, straightforward section. The second section deals with the investment, loan and investment by the company, the amount. Okay. Now, companies shall not directly or indirectly give any loan to any person or body corporate. So person is also caught here. Give any guarantee or security in connection with the loan to any other person or body corporate, or acquire shares of any other body corporate. So my total money which I can put in any other person is restricted. In last section we had directors, here we have other companies and person also. So how much is the restriction limit? 60% of paid up capital and free reserves, or and securities premium account, or 100% of free reserves and securities premium account, whichever is more. This is a simple calculation every auditor can make. Check the investments of the disbursements of the company, the loans given, guarantees given, make an Excel sheet, total it, match it with your paid up capital and free reserves, securities premium, and you will know on the face whether company is in compliance with 186 or not. Now, a clarification was given because we are now capturing any person to whom loan is given. The word person does not include a person in the employment of the company. So loan can be given to employees, and with cases it may exceed 60% of the paid up capital, free reserves, or 100% of the free reserves and securities premium. So it can go out to employees. There is no problem there. Keep that in mind. Now, very simple. It's a fairness clause. You can go up to this limit, no permission required. Beyond this limit, go to shareholder, take permission. After permission, go and give money to whomsoever you want to give. There is no restriction whatsoever. You can go out, give money, give guarantee, invest, no problem. But you need special resolution of your shareholders. If that is there, do it. So let's understand, this clause is again a fairness clause. You can go and do it provided you have taken approval of shareholders. It is not that it is prohibited. It is not prohibited. You can do it, but you need special resolution. Simple. The resolution should mention up to what amount you can go out and give money, loan, invest, subscribe. The amount should be mentioned. Very important. Some people I have seen practically, there are cases where someone has asked me, can I state that the loan can be 15 times my turnover? So what he tried to do is that by default he set a limit which will always keep going up by itself. This is not a right practice. You cannot have something like that. You need to have a tangible figure, that you need to have a shareholders who provide a more objective figure by which up to which you can give loan or invest. Okay, so avoid such kind of ambiguous resolutions is one point I can say. Exceptions, again, you can give money to your wholly owned subsidiary or joint venture, no problem. Obviously, because he is my baby only, no problem in funding him. Only thing, I should disclose the loans, guarantees, securities in the financial statements. this is disclosure is obviously coming in many companies, so there's no problem there. So very simple, I can go and give money to my wholly owned subsidiary, no problem whatsoever. Again, 186.4 is the disclosure part, which says that you shall disclose to the members in the financial statement the full particulars of the loan given, investment made, guarantee given, security provided, and purpose for which the loan or guarantee or security is proposed to be utilized by the recipient of the loan or guarantee or security. So I would say take this as the main clause. Whatever you do here, you go beyond and give, you have to disclose in the financial statement. So everyone has to take care that any loans, investments made are being captured in the notes to accounts. Let's look at certain other sections within the Companies Act. So 186.12 has brought an exemption for stock brokers or sub brokers or share transfer agents, because their business is largely in intercorporate loans. So no company registered under the section 12 of the SEBI Act and covered under class of companies prescribed shall take intercorporate loan or deposit exceeding prescribed limit, and they have to furnish in the financial statement the details of the loan or deposit. This is one section for SEBI registered companies. And 86.7, no loan shall be given under the section at a rate interest, this is important, lower than the prevailing yield of 1 year, 3 year, 5 year, 10 year government security process to tenure of the loan. This becomes very important, because if you are giving out loans, you can do it fine, but it has to be at least equal to the government security rate. Now this is where your funding to your subsidiaries, your funding to any entity comes into place, your employees, you cannot give it at low rates. Now 186.8 is for defaulting company. If company is in default, you cannot go out and make investments and loans, obviously, because the company is in default, repayment of deposits already taken before before or after commission act in either it could be principal or interest, then he cannot go and give loans or guarantees or securities outside, which is very obvious. When you have to pay your own people, why are you going outside and giving money? It's very logical. So there is no way that this can be overcome. This is a restricting clause, it will not allow. 186.9 talks about the register. Very important, register has to be updated for all the transactions that we just discussed. The register has to be maintained at the registered office. It is open for inspection, and any member can go and inspect that register. So this is one other fiduciary duty every company has to fulfill. The register that is maintained at the company is open to inspection at the office, and the members can take extracts and copies thereof may be furnished to any member of the company on payment of such fees as may be prescribed. Now let's talk about 186.11. These are certain exemptions given. Very logically speaking, a banking company, insurance company, NBFCs, a company goes in the business of infrastructure facilities or financing industrial enterprises, all exempt. Okay. Again, if you are making investment in if an investment company is making investment, no problem. If you are making investment in shares allotted as per section 62 or having a rights issue, so you can participate in rights issue, that will not come under the limit. In respect of investment lending activities by NBFCs, again not under the limit, obviously, because those are companies whose business is going lending, so they are allowed. In case of government company, again it will not apply, only if company it is other than listed company, and the government company obtains approval of the Ministry or Department of Central Government, which is administratively in charge of the company, or the state government before making any loan or giving guarantee or providing security or making any investment under the section. So this is something, if you have a government company or a Nidhi company or a bank, you'll obviously need to carefully look at these clauses. They don't apply in the same way they apply to all companies, which is very fair. I mean, it's something that would just out of common sense hit your head. Here I've written down some exemptions allowed to the specified IFSC public company and the private company. The board of these companies can exercise the powers by means of resolution passed by the board of directors or through resolution passed by circulation. So they have been allowed through board resolutions to go ahead with these limits. They should not apply if the company passes a resolution either at the meeting of the board of directors or by circulation also. And section 1 of 186 does not apply to specified IFSC public company. So they can have more layers of investments. That doesn't apply to them. A section 8 company also is exempt from 186 if 26% or more of the paid capital held by central government or state governments or both, or the loans are provided for funding industrial research and development in furtherance of their objects for which they have been formed. Obviously, so it is in favor of the government or their objects. There is no limit on the loan, investments, guarantees. They can do it. Very, very logical. Okay. What are the penalties under section 186? 25,000 to 5 lakhs on the company for any violation, and every other officer responsible. Mind you, it says officer responsible here because management starts operating without consent of board or shareholders. They will be in non-compliance. 25,000 to 1 lakh or imprisonment up to 2 years or both. So heavy penalties here as well. Care should be taken, especially smaller companies. Few important points to take away. Obviously, company in default and repayment of deposits cannot give any loan guarantee till default is subsisting. So this is something very, very important to be checked in your company before you go ahead. The disbursement exceeding a limit is to be previously authorized. So that means even if your board of directors comes and tells you, oh no, today I'm signing my contract, my limit is exceeded, please allow me, I want to disburse the money to XYZ. So that cannot happen. This clause is absolutely not something that you can ratify. It needs to be approved. You only if you have exceeded the limit without shareholder approval, you cannot go forward with this transaction. It will be non-compliance. Full stop. You can pass the resolution by postal ballot, so that will make it easier. Otherwise, you have to hold a company meeting to do it. So these are some of the important points which we picked up from 186. Now let's come to 188. Going pretty fast because considering the time we have. Now 188 is again, earlier I remember when I was studying CA, this was a very simple section. It's got more complicated over time. 188 is the intention of 188 is purely to have fairness in dealings again, because related parties are people who can take undue advantage. So the clause just basically says if you want to do related party transactions not at arm's length price or with outside the ordinary course of business, then you have to go and get a resolution. You cannot have that transaction without a resolution. So let's understand this way. The board has to approve all related party transaction. Management cannot go and do related party transaction without board approval. One. If it is going outside the course of business or outside the arm's length, then you need the board's approval and your audit committee and your board has to approve. And if you exceed the limits, then your shareholder has to approve. There's no other way. And these approvals should be prior, because related party transaction cannot be undone. The undue advantage goes to the other party, it cannot be undone. So this needs to actually happen prior. So company have to be proactive here. Okay, they have to be proactive. Let's take a look where related parties affect us. Now, when we as auditors or accountants need to look at related parties, we need to see them in these three places: Companies Act, SEBI, and accounting standards. Accounting standards, AS 18, Ind AS 34, depending on the applicable gap. SEBI will apply if you are a listed company or a subsidiary of the listed company in some cases. Otherwise, SEBI will not come into picture. But the larger play will be the Companies Act. As you understand, Companies Act is the procedure. Accounting standard is a disclosure standard. So all the procedure that we have to do for related party will be in Companies Act and SEBI. The disclosure that we have to do, so the work of finding the related party and disclosing the transaction is accounting standards. So let us not confuse the two. Let's understand them very conceptually. Today our topic is 188, so we will only look at Companies Act. But for everyone's understanding, this is how you should do it. So it is a good idea to start with Companies Act because that's a legal compliance. It's a law compliance. So you have to look at that. SEBI if listed. And accounting standards comes in the preparation of financial statement for disclosure purpose. So while they may be different definitions, first go with Company Act, identify related parties, then go to accounting standards. All right. Now, Company Act has a specific definition of related party, which is given under 276. Very elaborate description. Director is relative, KMP is relative, firm in which director, manager, relative is partner, private company in which director, manager, member is a director, public company in which director or manager is director or holds along with relative more than 2% of paid-up capital. Any body corporate whose BOD, MD, manager is acting as per my advice, he becomes my related party. Any person on whose advice, direction, instruction, director or manager of that party is accustomed to act becomes my related party. So anyone acting on what I am saying becomes a related party. The holding company, the subsidiary company, the associate company are related parties. The subsidiary of my holding company, on that side, my sister companies, all are related party. Defined, no exemption. And such are the mercy as prescribed. In that prescription, we have the director, the KMP of the holding company or his relative with reference to a company shall be deemed to be the related party. So the director and KMP of the holding company are also my related parties. Any payment going to them will also get captured in my net. Okay, one exemption good given here to other people who act on our advice are that if instructions are given in professional capacity, then those people acting on your advice are not captured as a related party, like professionals like engineers or lawyers or chartered accountants who deal with other parties who act based on their advice will be exempt. How do we check all this? It is for us as auditors to get into the relationship, understand the relationship, document the relationship. How does that person behave with that person? Does he have contracts with that person? Does he deal with him frequently? If he says that person acts on my advice, he is not a related party. You need to get into professional advice. What kind of professional advice? Look at the agreement with that agreements they have. Those things will let you know, and then you can document whether it's a related party or not. Talking about a person, the person specific definition we all are aware of. The HUF, husband wife, default related party. One person related to other in such manner as may be prescribed. The rules prescribe father, mother, son, son's wife, daughter, daughter's husband, brother, sister. So this is all from a personal point of view. Who becomes a relative, basically. That person is my, that relative is my related party. I'll not, get more into this. It's something we all have studied, and we all have to go back to the law and to see the definition. Okay, so here we have a common, let's say some case studies. So PQR is a private company, and XYZ is a public company. If you look at the first column, this is column number 2, the first case. PQR and XYZ have common directors, and the director shareholding in XYZ. So the private company has shareholding in a public company of more than 2%. In that case, XYZ, is XYZ a related party of PQR? Yes. The reason being, that XYZ is a public company. In a public company, I have 2% exceeding interest. That is the reason it's a related party. The other reason, now let's move to the next example. If PQR, XYZ are both private companies, I have common directorship, and data shareholding in XYZ is 2%. Even in case it is a private company, XYZ is still a related party. Why is that? Because you have common directorship. So percentage doesn't apply in case of a private company, but there is common directorship. So it got caught in that web. The third case, I'll say PQR, XYZ, both are public companies. They have common directors, but they are public companies. The director shareholding is nil. Okay. Now in public company, you can have a common director. That's not a problem. That company does not become a related party. Private company, yes, becomes a related party. Public company, no, unless it exceeds 2%. The next case, PQR is a public company having common directorship in XYZ, which is a private company. Shareholding is nil, but it will be a related party because there is common directorship of a public and a private company. Because if you look at it other way, it's a private company also going the other way around. Now, identifying a related party is not based on principle of reciprocity. It is possible that one company identifies the other company as its related party. However, it doesn't mean that the second company will also identify the first one as a related party. This is something important to be kept in mind. Okay. Now, where do we need approval of a related party transaction? Now, as such, as I said, all related party transactions need to have approval. So if you look at the left side, if related party transaction is at the arm's length and in the ordinary course of business, it's allowed, but audit committee approval and subsequently board's consent will be required. Both will be required annually, every year. Okay. Let's go to the right, which is the more heavier part. A related party transaction which is not at arm's length, or it is at arm's length, not an ordinary course of business, or both. Company has to stop there. This is something now we need to think, okay, what to do now, because that person who I am going to transact with is a related party, fine, but now we are not transacting at arm's length and we are not transacting in the ordinary course of business. Immediately company has to take note and stop. That entire detail has to go to the audit committee, who has to approve it, which will then go to the board committee for approval. All right. And if those transactions are very large, very huge, exceeding the threshold, if it breaks the threshold, shareholder approval must. And one thing I would like to state to everyone, that it is best and important that the approval should be prior, should not be post. Many clients do argue that let me take the approval in the next meeting from the shareholder, but that is not right. You have to take it prior, because you cannot enter into a contract as per the section. All right. So let's understand this. When you take, when you are doing, if they have not crossed threshold, board approval is sufficient, but you need the prior consent of the board for resolution passed at the board meeting and compliance with all the prescribed conditions they have stated. If it exceeds, you need board's approval because he will recommend to shareholder, then shareholder has to approve all those transactions where the amount exceeds. Okay, not all, only the transaction where the amounts are exceeding the prescribed threshold. Now let's look at some. If you see the footnote, there are some matters there which are very important. One, the transaction is not on an arm's length price and a material contract arrangement transactions, they have to be disclosed in the board's report. Let me extend this by saying board report has to have all the transactions. All these transactions have to be listed one by one in the board report, not one general clause, one by one specific. And against each transaction, board has to give justification why it has entered into those contracts. So this is something very transparent. So when boards are approving the transactions, very necessary that that reason be documented and minuted there itself, because that is go in the board report. Board report will go to every shareholder. So this is very essential and very important to take care. This is absolutely transparency clause. You can understand what I'm saying. Next, in case prior approval is not obtained, there is an option to ratify the same within a period of 3 months from the date of the transaction. Now, this is only in certain cases allowed, not in every case. Okay. Our suggestion always is that it has to be prior. It has to be a prior approval. But certain cases are there where it may not have come to attention, or it may have happened inadvertently. Then I would say you can take the support of this clause. Third point, the arm's length transaction. What is the arm's length transaction? Means the transaction between the related parties is conducted as though they were unrelated. Now, I personally feel there may be a slight challenge, especially if it's a specialized industry and I'm selling very specialized goods, okay, which nobody makes or nobody gives that kind of service I give, and I enter into transaction with other company. There is no comparable competitor in the market, so it will be difficult to say what is the arm's length price. In such case, it is something for companies to really do some research and really document that it is an arm's length price. Because see, if it's not an arm's length price, it needs approval. Okay. If it is arm's length price, you don't need approval. So this is something very delicate. And this is the most delicate part in related party transaction in this company and compliance. So we need to take very extra care. Auditors should do as much as they can to get an arm's length price. A lot of research will be required. Professional skepticism will be required. But much of the time you'll have to go to the client and ask him to get a prepared report by an expert or someone. Now, let's look at the conditions where the limit for the shareholders approval has been prescribed. What is the limit? Any sale, purchase, supply of material directly or through agent. If it exceeds 10% annual turnover, I have to go to shareholder. If it is less than 10%, no need to go to shareholder. Very simple. Next is the capital transaction: selling, disposing, buying property of any kind, directly or through agent. Again, if it is more than 10% of the net worth, fine. You need shareholder approval. If it is less than 10% of my net worth, you don't need shareholders approval. Leasing of any property of any kind, again, more than 10% of the net worth or 10% of turnover or 100 crores, whichever is lower, you will need. If it exceeds, you will need shareholders approval. Availing or rendering any service directly or through agent, more than 10% of the turnover, any services. So when we say services, this is very large. It could be contract, it could be a insurance, any kind of service that you pick up or you deliver. Availing or rendering. So if I'm taking service or I'm giving service, if it exceeds 10% of turnover with a related party, it will be captured here. So any commission agreements, sale, advertising agreements, such transactions which could become high value, you may not realize also. Those all will need shareholder approval. Marketing services, right? Any position given of profit in office or place of profit given in my company, subsidiary company, associate company, where the monthly remuneration exceeds 2.5 lakh per person, and that person is my related party, I need shareholders approval. This is the blanket figure here. 2.5 lakh per person, doesn't matter the position, whether he is at a manager or a CEO level. If it's exceeding 2 lakh rupees, 2.5 lakh rupees, you need the resolution of shareholders. Any underwriting and subscription of any security derivatives which is more than 1% of the net worth by a related party will need shareholder approval. Okay. These are the clauses of CARO which come upon the auditor to report. So you need to report whether or not there have been transaction between related party. One simple question. Whether all the transactions related party are in compliance with 177, 188 of the Companies Act where applicable. This makes it a little wide. You need to have a small checklist in place where you will do certain checks to ensure that all these transactions are in compliance with 188. When I say compliance 188 means all of it, whether it is being approved, if it is within limits, if it is beyond limits, whether approval of shareholder is taken, all that company has to do, document, show you, you need to check, you need to review minutes, and you need to give your reply here. There is a detailed disclosure of related party in the financial statements. That also we need to see as per accounting standards, whether it is proper or not. So while the clause has 3 points, this is a very exhaustive clause. Whatever we discussed in the last 15 minutes, all of it will have to put into play to check this matter. Some important points everyone can pick up. The challenge actually lies in searching for a comparable transaction in arm's length price. Like I said, if I'm in a specialized industry, it's very difficult to get an arm's length price. Non-independent director can receive stock options. He is allowed to receive, fine. But where, let's say they exceed 2%, that company then becomes a related party and all these clauses will apply. That's something you take care of, the 2% clause. Board report needs to have a justification for each transaction related party. Not one para, not one description of a para saying that, okay, multiple transactions were entered into for the benefit of the company or for certain so and so reason. No. Transaction by transaction, you need to give a justification. Where the holding company has passed a resolution for the wholly owned subsidiary, it is sufficient. The subsidiary does not have to pass another resolution because I wholly own that subsidiary and the same management. That is why. If a person becomes a relative post appointment, it's fine, as the clause requires assessment of related party at the time of appointment. So a person became relative after appointment, you don't need to go and take approval, okay, because he's at the time of appointment he was not a relative, so it's okay. Companies can use the postal ballot options to get their resolutions faster, easier, rather than holding a company meeting again. Okay, so that's basically everything that I wanted to cover. It's about 5 just on time. So right now what we've done is we have scraped through the surface on these sections. Lot more as you consider the practical scenarios, there will be a lot to think about, but I think if you go through the basic concepts, it will be much easier to decide where you stand, whether with law or against the law. So this was what I had. If anyone has any questions, we have you take up or later.
Thanks, Aleem bhai. I think Sharon, Bhavna, both of you are around. If you, Mishaji, if you could put up some questions. Friends, anyone who has a question can please post the questions in the comments box or in the questions section, and we can just recreate it in front of the screen. Sharon, if you could read out anyone, I mean, Sharon, if you could read out these questions.
Yeah. The first question is, motor car purchased by company and registered in the name of director. So is this a related party transaction or not?
I think we've seen this does happen. Now there are two things. You know, first we are saying it's purchased by the company, so it's paid by the company, and it's registered in the name of the director. So it's quite obvious. It looks like the invoicing and everything is in the name of the director, just that the payment was made out of the company's account. if you would personally ask me, this is something. It's more about the proprietary of the transactions. Every asset purchased by a company should be in the name of the company. If they are transferring these assets to the name of the director, it is indirectly, it's not right actually, the transaction. So if is there, I mean, first I would question the propriety of the transaction, that how is this possible, and rather the money should be recovered back, because the asset has been transferred to the director. You cannot recognize that asset in your books. So that's the first angle you need to see. And secondly, yes, if you determine that this is a loan to the director, or if it's recognized as a loan recoverable from the director, then it would come under 185. I think that's the angle you need to go back. Where if you call strictly a related party transaction, I would say yes, because you have purchased something for the director. So before going to related party, I am questioning, how can you buy it for him? It's not his asset, it's company asset. Why is it in his name? So I would first highlight that as a red flag.
So
Yeah, if the director is going to pay you back for it, yeah, it's it's like it's not exactly, I would say, see, this is not a sale or purchase of goods. Okay, it's more of a loan, if you ask me. So I would take it to that section. 185.
so the next question is
Important point here could also be, sorry to interrupt, Aleem bhai, and we've seen in some of the cases is, suppose all of this purchase, all of this cash flow has happened at the cost of a compliance. I think then it's a crime. Then I think it's a bigger issue to tackle. And like for example, if there is a due date of GST, and instead of paying that GST, and we have incurred a penalty because of late payment of GST, and at the cost of that we purchased this motor car. That cash flow therefore becomes, and the timing becomes very important. Largely, if we come across some of these kind of transactions, even if it is a RPT or not, this becomes a very serious one, and probably takes, as Aleem bhai mentioned, a serious red flag.
Yes. And just to answer the question, it's a related, I don't know how to call it related party, but yes, you're doing a transaction with the director. If you call it a fraud, it's going another way. If you call it a transaction, for whatever arrangement you have, it's a related party, because you are doing a transaction with the director outside the normal course of business terms of appointment.
Right.
Yes.
Next question, please.
next is board approval needs to be taken for RPTs. So if it exceeds 10%, so then approval need to be taken from shareholders through resolution.
This is not so simple. The question has two parts. If board approval needs to be taken for related party transaction, my answer is yes. If it exceeds 10%, then approval needs to be taken from shareholders through resolution. Answer is yes, for those specific thresholds given and particular types of transactions mentioned in Rule 15, which I said, like sale purchase, it is more than 10% of turnover. For property leasing, it is more than 10% of net worth. So you have to go by those criteria. If exceeds that threshold, then go to shareholder. If not exceeding the threshold, then you can stick to board. No problem.
Okay. Next question is, okay, I think it's in continuation of the second question. Here, whether board approval is to be taken before start of the year as blanket approval, or as and when transaction arises, the approval can be taken after transaction or before transaction. Further, requirement of AGM approval and resolution, whether before the transaction or after the transaction. So I think
Okay.
they are asking the timing of the approval.
Right. So, like I said, this is, so I will put your transaction in two parts. One is the transaction you are doing every year. So let's say you are company A, your brother sisters own company B and C. Every year you are dealing with those companies. You know your value of your transactions. You know the contract. Contract is final. You are just renewing every year. So every year you can have a procedure where every year the renewal is approved by the board and shareholder. So those things need to be, the contract needs to be approved. It cannot be blanket. I mean, there needs to be a transaction identified. Okay, so you have to say transactions. We will enter into contract with company B for transaction of amount of rupees, let's say approximately 50 crores for supply of goods and services for the year financial year 22-23. That approval can be taken. You start doing your business with them. You have to keep in mind when that 1 year is finishing, and before that 1 year finishing, you should be taking approval again. Okay. So if you ask me, you should identify the contract. Secondly, I would always say that the approval should be prior, but this is something debated with many clients, that sometimes it is not just possible to do this. So there is a provision in the law under the section under 188(3), where it says that any contract or arrangement is entered by a director or other employee without obtaining consent of the board or approval in the AGM in the general meeting under subsection 1, and if it is not ratified by board, as the case may be, by shareholders within 3 months from the date of such a contract or arrangement was entered into, such contract shall be voidable at option of the board or the shareholders. And the contract related party, any director so authorized or any other director and the director concerned shall indemnify the company against any loss incurred by it. So if you go ahead without approving your transaction, okay, you may have 3 months to ratify it. If still it is not ratified, then board will that director who is interested in the transaction, he will indemnify the company for any loss, and that contract is voidable at option of board or shareholder. So these clauses make it very necessary that you should try to take by a prior approval as far as possible.
Okay. Next is the limits should be considered related party wise to aggregate of total RPTs.
It will be related party wise. So let's say sale transactions of a particular limit. So if let's say with party A, I am doing sale and lease. So I have to measure my sale as per the sale contracts and lease as per the lease contracts. Okay. So if my sale contracts exceed 10%, then I need shareholder approval. But maybe my lease contract do not exceed 10% on net worth, then I need only board approval. So split that. You have to see the transaction that you are doing throughout the year, for the full year, 1 year, not single 1 year.
Okay. So what are the documents need to be taken from the management for these RPT transactions?
First, of course, you should start with their register. If you check the 189 register, you will have majority of the parties there. Then you need to inquire with management how they are identifying their parties. You need to look at the minutes to identify new parties that have recognized in the year and what contracts have come, new contracts that have come this year. Once you have all this and you have identified the real parties, you run through the ledgers to understand the transactions. And I would always advise, take the agreement with the related party and match it with the resolution passed. So look at the agreement, look at the resolution. That will be very good documentation as if it's in line, it's sync.
Okay.
So
If Caro is
passed, board, shareholders both, and the agreement for the related party transactions and the ledgers all should be scrutinized. Yeah, sorry.
Next question is, if CARO is not applicable to a company and if there are RPTs, how and what to disclose?
The auditor is not required to disclose in case CARO is not applicable, but company is required to disclose as per accounting standards. So as per accounting standards, make the disclosure in the financial statements, in the notes. And you'll need to check those disclosures. So obviously you need to do some procedures. So indirectly work is there, but you don't have to disclose in order to. That's the only difference.
All right. So I think there's one more question. I think largely they are all online. I think we've arranged, we've addressed all of them. Additional documents auditors should look for over and above the agreement for loans, investment, and the resolutions. Any case study that comes in your mind wherein you have been able to identify some undisclosed RPTs, and how did you do that?
Sometimes I've seen people skip looking at last year's files. So if you look at last year's disclosure, first identify where that transaction went, why was it stopped, or did it take another form? So for example, I was selling certain material to a related party, and all of a sudden that has stopped, and maybe it has taken some other color. I mean, I'm raising a red flag here. That's first step. You should do that. Look at the board report, look at the last year's transactions, and try to make sense of why those transactions stopped this year. Because it's very often that related party sometimes is done with a evil mind. So it takes another color. Maybe they are funding a land purchase. All of a sudden, it has become a loan now. You need to ask this question: why last year we were having loans with the company, now we are doing sale purchase transactions? What is that company? Why is it changing? Why did we suddenly do new business with them? That is one question you must ask. So any new related party, please ask, who is that party? Why him? Why not others? Did they do a market study? Maybe it is cheaper to buy from other people. What is the reason to go to that related party? These kinds of questions should start coming. Then when you are satisfied, search online to see, is that related party really in that business or it is a camouflage? Rest I think it is your skepticism in place, but very important to pick up. First, try to identify related parties, see what management has thought, look at your definition. If everyone has been caught, take those names and run through the ledgers, and if in the ledgers you find new transactions, those are the new related parties.
I think JV
Again,
accounting,
no fixed rule on this.
I think JVs would be the best way to identify these. I just recall, because as you mentioned, immediately
100% JVs.
DP also, they would keep on changing these parties, for getting them in 60 days or a 90-day period. JV accounting, wherever you come across, I think they are largely through related parties. Of course, they would be camouflaged, as you said.
JVs would already be caught and scrutinized separately. Definitely from there we will get the related parties. But these are parties who are now locked into your client masters in different forms as loans, creditors, debtors. So that's the reason I'm saying one step ahead.
Perfect. All right, I think that's it. There are various other questions, and yes, the next session that we have, disclosures, because there was question right now, if CARO is not applicable, then what about RPD? So that comes in the next session, that gets answered by our next expert speaker, C. Amit Hundia. I welcome C. Amit Hundia, sir, on the screen, and to do the well-deserved vote of thanks for this session, I invite CA Bhavna. If you could please do the vote of thanks for C. Aleem sir's session. Over to you, Bhavna.
Thank you, Aleem sir, for a wonderful session. The various scenarios considered as case studies and illustrations, and its in-depth explanation is very helpful. It has widened our understanding and skills, and it will definitely help in our practice. Your valuable time and knowledge sharing is commendable. Thank you so much, sir. Thank you.
Thank you very much for this opportunity. It was my pleasure.
Thank you, Aleem bhai.
Thanks, Arpit.
Bhavna, may I also request you to please introduce our next expert faculty, C. Amit Hundia, sir.
Yes. The second topic is disclosure in the financial statements with respect to amendments in Schedule 3. So this session will be taken up by Mr. Amit Hundia, who is a chartered accountant, a company secretary, LLB, and DISA expert. He possesses rich working experience of more than 2 decades in the field of assurance and advisory services. Presently, he is a partner at Singhi and Company, Chartered Accountants. Previously, he was partner with Hari Bhakti and Company LLP, Chartered Accountants, and have spent more than a decade with them. He possesses the international exposure and has worked on secondment in New York and other places of US, specializes in the field of company law and corporate governance matters, and has in-depth knowledge of accounting and auditing standards. He has worked on assignments as a technical reviewer for Quality Review Board, technical reviewer for Financial Reporting Review Board. His industry exposure comprises of NBFCs, housing finance, stockbroking, real estate and infrastructure, gaming and hospitality, manufacturing and service sectors, etc. He has given various lectures in various forums, including ICI. So we are very lucky to have you, sir, and it will definitely increase our understanding towards disclosure in the financial statements. And I welcome you.
Thank you, Bhavna, and welcome, Amit, sir. Really a pleasure. Thank you for taking out time and sharing this important aspect with us. To all the audience, let me tell you, recently we've received a very serious notice in terms of a listed company with their published accounts in an old schedule. Absolutely, the disclosures and absolutely the balance sheet, they were all in the older schedule. So I think that is a huge mistake, and I think if signed financials of a listed company are coming in this shape, it's gonna be a very, very difficult task for various people involved in this entire scenario. So I think therefore this session becomes very crucial for us, and a very well speaker, Amit Bhai, was always been with WRC. So thank you, sir, and over to you.
Thank you, Arpit. Thank you very much for a nice introduction and warm welcome. So I know Arpit very well from a long period of time, and he's, as usual, always a hardworking person, and he had brought a lot of good changes in the ICI and WRC forum, along with Murtuza and other members. So once again, thank you very much. It's my pleasure. Thank you, Arpit. So I'll start my session. How can I share my screen? Can someone please?
So we can see your screen already. You can just put it on slideshow mode.
Okay. Is it
Perfect?
visible?
Yes, sir, absolutely.
Okay. Can I minimize the screen right side?
So you can do that.
Okay, my screen is visible, right?
Yes, you are on the first slide. Now we are on the next slide.
Okay. To begin with, I mean, what Arpit said in a very right manner, that there are changes which are prescribed under Companies Act 2013 and which are quite critical. Schedule 3 amendments are severe, have brought out severe changes in reporting requirement, and these changes became applicable from the current financial year. One should be very much aware, aware about these changes, as these changes have long-lasting impact, and a good amount of disclosures or informations are required to be pulled out by the management and need to be disclosed in the financial statement. So as we see in our first noting, that these amendments became applicable, I mean, from 1st April 2021. They were issued, Schedule 3 amendments were issued on 24th March 2021, and they came into effect from this particular financial year. MCA has also simultaneously amended CARO 2020, which also came into existence from this particular financial year. Requirements of the Schedule 3, however, do not apply to companies which are referred to provision of 129(1). So that means insurance or banking company, to them Schedule 3 is not applicable. Other than that, Schedule 3 is applicable to all the corporates. So to begin with today, I mean, we'll just see the applicability of Schedule 3 requirement. Revised Schedule 3 is applicable for all the full-fledged financial statements. So when I say that this is applicable after 1st April 2021, so even if any full-fledged financial statement was supposed to be signed for a period ended December 2021, maybe for a calendar year purpose for the reporting requirement with the consolidation of the parent company which is based outside India, then for that period also Schedule 3 will be applicable. Or we have seen that recently a lot of companies came out with IPO when they have filed their DRHP or RHP with the regulator. They are supposed to comply with the Schedule 3 when they issue their audited accounts subsequent to 1st April 2021. And they have incorporated all those amendments in their DRHP or RHP filed with the regulator. So it is applicable to year-end financial statements and interim financial statements. Along with this, one very important thing which we should learn or remember that these disclosures will also become applicable for the comparative financial statement. So if we are presenting a comparative financial statement, so for example, financial year 21-22, if we are presenting for 2021, but obviously we will present, then these changes will also apply to that particular financial year, and the financial statement should be modified to that extent accordingly. Further, so as we know, I mean, so we'll go further and we will discuss that when it can be required for more than 2 years to be presented in revised Schedule 3 requirement. So Schedule 3 is divided into 3 parts. First is Division 1, Division 2, and Division 3. So it is very important for us to understand when Division 1 will be applicable, when Division 2, and when Division 3. So there are differentiating factors which are required to be covered for these particular financial statement. Division 1 is applicable to entities who are preparing their financial statement as per accounting standard. So these are those entities, those entities which are falling under Division 1 are not supposed to comply with Ind AS. So any entity which is not complying with Ind AS, they will by default fall under Division 1. And Division 1 requires an entity to prepare the financial statement as per Schedule 3 for Division 1 requirement. I mean for non-Ind AS financial statement. Division 2 is applicable to those entities to whom Ind AS is applicable. So right now, like what Arpit rightly said, that in case of listed companies, Schedule 3 is applicable, amended Schedule 3 is applicable, which is Division 2. So, I mean, if someone missed out to have the financial statement prepared as per Division 2, or maybe to incorporate the amendments of Schedule 3, then it's a gross non-compliance to that extent. So Division 2 is applicable to all those entities who are preparing the financial statement as per Ind AS. Division 3 is applicable to NBFCs who are preparing their financial statement as per Ind AS. So friends, please remember here, if there is an NBFC, so all NBFCs are not supposed to comply with Division 3. If the NBFC is falling under the criteria of Division 3, maybe like for example, if it's a listed NBFC or if it's a subsidiary or holding of any company to whom Ind AS is applicable, then Ind AS will be applicable. Otherwise, if it is not falling under those criteria, then Division 1 will be applicable to that NBFC. So this is a very important factor to understand, that on all NBFCs, Division 3 will not be applicable. It needs to be evaluated. Now, if we see, like I was just describing, that in case if we prepare financial statement for 3 financial year, so when can it happen? So it can happen when we are preparing our financial statement as per Ind AS, or maybe like when we are filing our documents for DRHP or RHP purposes, where we are supposed to give 3 years financial statement period. So if we are amending our financial statement for the first time to make it in line with the Ind AS, we need to give a comparative financial statement, the opening balance sheet. So in that case, all the 3 balance sheets which are presented in the financial statement will be as per Schedule 3 if they are being presented for year ending March 2021. So this is very important to remember. So there will be 3 balance sheets, and all those 3 balance sheets will be as per the requirement of amended Schedule 3. So again, it is very important for us to know what are NBFCs. I mean, in normal layman term, we believe NBFC means a company which is financing, which is carrying out its business of financing. But here, for the purpose of Schedule 3 requirement, I mean, they have come out with a applicability norm, or even for the India's applicability norm, the regulator had said that these entities will be considered as NBFC, though as per the RBI, they will not be considered as an NBFC. So here, if we see specifically, I mean, for example, stockbroker or subbroker companies, by law, they are not NBFC, they are not governed under the RBI regulations. However, for the purpose of preparing their financial statement, they have to consider the requirement of Schedule 3 if they are meeting the criteria. So, for example, here if we take if there is a broking company whose assets are of more than 300 crores, for example, net assets are of net worth is of more than 300 crore, then Ind AS will be applicable to it. So if Ind AS will be applicable to it, it will not be Schedule 2, it will be Schedule 3. Vice versa, if the broking company is having only a turnover of 50 crore, or for example, net worth is only of 50 crores, in that case, the Ind AS 3 will not be applicable, Ind AS 1 will be applicable. Because this will, though it will be considered as an NBFC as per the requirement of the regulations, for the purpose of complying with the presentation of financial statement, Division 1 will be applicable. So these entities are required to be considered and evaluated while seeing that whether Division 1 will be applicable or Division 3 will be applicable based on the applicability criteria of Ind AS on these entities. Schedule 3, I mean, what we are going to discuss today. So we are going to discuss today mainly amendments with regard to balance sheet, P&L, and other additional disclosures, which are as issued by MCA in the recent past. And the discussions will happen on Division 1 and Division 2. So if we see, these are the changes. So first thing which has been brought out in the amendment is this, that now the rounding off is mandatory under the Companies Act for presenting the financial statement. So earlier it was voluntary in nature. Now they have made it mandatory, and it will be based on total income rather than considering the turnover requirement. So the base has been increased to some extent because total income will cover other income and the turnover both. So if the total income is of less than 100 crore, then it will be to nearest 100,000 lakhs or millions. So the option to present the financial statement in crores is not available if the total income is of less than rupee 100 crore for any company. On the other way around, if the total income is of more than 100 crore, then it will be nearest to lakhs, millions of crores. So in those cases, it cannot be near to 100 or 1000. So for example, 110 crore is the turnover. Company has an option to present its financial statement in the figures denominated in lakhs, millions of crores. So they have the amendment has prescribed the requirement that how the figure should be presented in the financial statement of any company based on its income criteria. And once these rounding off requirement are considered by the company, either for example in lakhs, millions or crores, then they will be applied consistently across the financial statement and subsequent periods. Division 1 again. So first we'll discuss for the changes which are suggested in Division 1. Division 1 mainly, as I said, discuss with the financial statement which are presented as per non-Ind AS requirement, and substantially Division 1 will cover all the amendments. When we'll move on to Division 2, I mean, there are certain additional amendments which will be captured, so which you can understand. In Division 1, they have modified the requirement to present the non-current assets on the face of the financial statement. Earlier, as we all know, friends, the heading was of tangible assets, whereas the accounting standard says, or the AS10 heading is property, plant and equipment. So now they have worded it as property, plant and equipment and intangible assets, and word is included, and intangible assets, because intangible asset is a separate asset and tangible asset is a separate asset. And they have replaced or substituted the word tangible asset with the property, plant and equipment. So this is a nominal change which is made on the face of the financial statement, which is again in line with the requirement of accounting standard. For PPE, there is a separate accounting standard which is AS10, and for intangible asset there is a separate accounting standard AS26. So both the assets, both the assets will be shown separately. Both the blocks of assets will be shown separately. Friends, this is something new which is required to be given. So here, if we see, earlier there was no requirement for disclosing the promoter shareholding, though in case of listed companies in annual reports, the listed companies were giving the shareholding of promoter and promoter group company as per LODR requirement. So they were also considering promoter group for the purpose of disclosure. However, now in case of Companies Act, when we are presenting the financial statement as per Schedule 3, the Schedule 3 also requires to disclose the shareholding of promoters, and that will be for all the entities either falling under Division 1, 2, or 3. However, they are not covering the disclosure requirement for promoter. So what is the requirement here? If we see, the requirement is shares held by the promoters at the end of the year, promoter name, number of shares, percentage of total shares, and percentage change during the year. So this is the requirement, reporting requirement, which needs to be given in the financial statement. So here the Schedule 3 says that promoter should be considered or identified as per the definition given in the Companies Act 2013. So who is the promoter? Promoter is a person who is named as such in a prospectus, or is identified by the company in annual return, or has control over the affairs of the company as a shareholder, director, or otherwise. So these are the three key criteria. So normally, or what as an auditor, what we should do, or as in management, what what management should do when the financial statements are required to be prepared. They should pull out the details as per MGT 7, which is filed with ROC, which will cover the details of promoters, and the details of those promoters are required to be given here, along with the number of shares and their percentage of holding. There is no reporting requirement in CARO. So friends, we will also touch upon on the requirement for CARO 2020, whether any clause which is required to be reported as per amended Schedule 3 is also required to be covered as per CARO or not. That will give a better clarity, and maybe at a later end we are also trying to give the comparison between Schedule 3 and CARO 2020 that will ease out the understanding requirement, because some requirements are completely common, some requirements are overlapping, something which is required as per Schedule 3 not required as per CARO 2020, or vice versa. So the responsibility of auditor is not getting diluted in macro sense. Whatever is applicable in a larger horizon is required to be considered by the auditor for the purpose of disclosure reporting as and when where it is applicable, either for Schedule 3 or CARO. But the efforts for verifying those details and documenting is very much essential on the part of auditor. Here now we should remember, like we discussed, that we need to give shareholding of the promoters for the current year and for the previous year, as the Schedule 3 amendment required that these informations are required to be given for the comparative period also. However, in this regard, guidance note on Schedule 3 states that the number of shares and percentage of shares held by the promoters as on the beginning of the comparative year is also required to be given, so that the percentage of change can be understood by the reader of the financial statement. So in that case, we will have to give 3 columnar disclosure. One will be for March 22 as on March 22, second will be as on March 21, and the third will be as on 1st April 2020, because it says disclose number and percentage of shares at the beginning of the year. So beginning of the year is 1st April 2020 and not 31st March 2020. Again, here this will be very much relevant. Why we are emphasizing more on 1st April 2020? Because I'm just taking a practical example where we have dealt recently. A company came out with a scheme of arrangement, and the appointed date of the scheme is 1st April 2020. So the promoter shareholding is different as on 31st March 2020, and it is different if we give effect to the scheme of arrangement on 1st April 2020 because that is the appointed date and where the NCLT has approved that particular scheme. So in that case, the percentage of holding of promoters gets completely altered as on 1st April 2020. So that is very much relevant here. We need to cover the percentage of holding and number of shares as on 1st April 2020. If we give in that case, in that example, which I am giving right now, if we consider as on 31st March 20, it will be totally wrong because the holding was different as on that date. 1st April 20, it gets altered due to the NCLT order when we are giving effect to that particular scheme. So this is very important, very relevant to understand that why 1st April is relevant for comparative period, which is given in the financial statement. Short-term borrowings. Now, in case of short-term borrowings, as we remember earlier, current maturities from long-term borrowings were covered under other current liabilities. Now it is required to be disclosed separately in the financial statement. And no reporting in CARO 2020 with regard to this matter. And current maturities of long-term debt is omitted from other current liabilities. So current maturities from long-term borrowings will now form part of short-term borrowings. So it will be now easy to understand that this leg of long-term borrowing, which is going to get repaid within a period of next 1 year from the end of the financial year, from the end of the balance sheet date, is getting captured as a part of short-term borrowings. And this will also affect the ratios which we are required to disclose in the financial statement as per the new requirement or the amendment carried out in Schedule 3. Trade payables. Friends, again, if we remember, in case of trade payable, earlier the disclosure requirement was very limited. Now the disclosure requirement is exhaustive. So earlier the disclosure was only with regard to trade payable, outstanding for MSMEs and outstanding for other creditors. Now the requirement is quite exhaustive and it has to be further, the period for which it has been overdue or due has to be further broken up and has to be disclosed in the financial statement. So here, I have just tried to depict the requirement. So the left column demonstrates the earlier requirement of Schedule 3, the present requirement, and the right column demonstrates the additional requirement. These are the additional requirements which are required to be incorporated in the financial statement. So these will ease out for the audience to understand that what was earlier required, what is now required, and whether anything required to be covered in CARO 2020 for that specific point or not. So in this slide, if we see on the right side, now the trade payables are required to be segregated between MSME, others, disputed dues MSME, and disputed dues others. So this is very important, and then it has to be further broken up based on the aging, and the aging is required to be given for trade payables which are outstanding for less than 1 year, 1 to 2 year, 2 to 3 year, and more than 3 year, and then total. So, so for example, if we say that there are trade payables which are outstanding for more than 2 years, so then there will be questions. So why the trade payables are outstanding for more than 2 years and they are not disputed? So if they are not disputed or more than 3 years, why it has not been paid off? So both the things cannot happen simultaneously. Either they are disputed and then they are outstanding for more than 2 years or 3 years can be understood. But if they are not disputed and if they are outstanding for more than 2 years or 3 years, there may be a probability that these trade payables are not required to be paid off, but they are just simply carried out by the management and maybe returned back in future periods just to make balance between the tax matters. So this will give complete coverage for the regulator or for maybe tax authorities or the stakeholders to understand about the timelines of the company to make payment to its creditors and whether the creditors or the payables are actually payable within a short span of time or not. And further, with regard to MSMEs also, government will be able to track whether the payment of MSMEs are also happening within the time or not. Government is very keen to look into the fact that the dues to MSMEs are paid in a timely manner, and pursuant to that, government is trying to bring out lot of disclosure changes in the financial statement so that it can be easily known to the regulator, to the reader of the financial statement, that whether the MSME dues are paid in time or not, and if it is not paid, then interest is required to be provided on that outstanding amount. So here, I mean, if we understand or if we try to consider what would be the due date of payment, so the amendment says that the due date of payment will be the due date which is prescribed in the particular invoice. However, if the due date is not prescribed, then it should be considered from the date of transaction. And then the requirement of Schedule 3 also says that unbilled dues are required to be disclosed separately. This is a reporting requirement, hence it does not have any implication in CARO 2020. Title deeds of immovable properties not held in the name of the company. So again, if we see here, this is again one of the very important change which has been brought up by the amendment in Schedule 3. So the company now is required to provide the details of all immovable properties whose title deeds are not held in the name of the company in following format, and where such immovable property is jointly held with others. So if immovable property is jointly held with others, details are required to be given to the extent of company share. So there can be a possibility A Limited is holding jointly an immovable property along with B Limited or C Limited. So the disclosure here is required to be given only to the extent of A Limited in its financial statement, if the immovable property is not held in the name of the company. So the disclosure is like this, relevant line item in the balance sheet. So the immovable property, as we know, can be categorized in any of these four columns, which are 4 rows which are presented here. So first is PPE. Land and building can be considered as a part of PPE. Land and building can also be considered as a part of investment property. Land and building can also be considered as a part of non-current assets held for sale, and land and building can also be considered as part of other, maybe like for example inventory, etc. However, inventories are not covered for the purpose of this disclosure requirement by virtue of the clarification given in the guidance note. Then it says that, I mean, the disclosure requirement is this, that we should also give gross carrying value of that particular asset, title deed held in the name of whom we should give that, though it is accounted in our books, but the title deed is in the name of someone else. And further, we need to describe whether, when I say we, means the company needs to describe in the financial statement whether title deed holder is promoter, director, relative of promoter, director. So whether they are falling under the category of related party or closely held kind of people, then details are required to be given with regard to that particular fact. Property held since which date? I mean, since which date we are holding that particular immovable property, and reason for not being held in the name of the company. I mean, this is very important. Earlier, the reasons were not required to be given. I mean, none of this disclosure was required to be given. Now, with this, I mean, a lot of transparency will come into the financial statement. And there can be a possibility in case of PSUs where large land banks are there or historical assets are there, which may or may not be in the name of the company. I mean, there are probabilities or the old companies for any of the reasons. So the reasons are required to be specified that why these title deeds are still not converted into the name of the company, though the asset is accounted in the books of the company. Here again, important thing to consider, relative. When we say relative, should be relative as defined in Companies Act 2013. Friends, please understand, a relative is having a different definition in Companies Act. It's different under Income Tax Act. It's different under AS. It's different under Ind AS. So, I mean, these 4 regulations or the 4 requirements specify related party or relative in a different manner to some extent. I mean, more or less it is in line, but again, to some extent there will be deviation. So we should be very vigilant that here, for the purpose of giving disclosure as per Schedule 3, relative should be covered as per the definition given under Companies Act 2013, and promoter should be considered as a promoter which is defined in Companies Act 2013. Similar kind of reporting requirement with regard to title deed of movable property is also there in CARO 2020. Now we'll move on to the next slide for capital work in progress. In case of capital work in progress, the present requirement was only that capital advances should be shown as a part of long-term advances and not as a part of capital work in progress. And it should be shown, capital work in progress should be shown as a separate line item on the face of the balance sheet. Now the requirement has been elaborated by the amendment in Schedule 3. Now it covers the information for both the parameters, capital work in progress and intangible assets under development. So earlier it was only limited to capital work in progress. I mean, that was completely debatable or arguable at that point of time. People were not inclined to give details for intangible assets under development separately. I mean, though it was required to be given, but now the disclosure is required to be given in an exhaustive manner. So here the aging schedule is required to be given for capital work in progress or intangible assets under development. So we need to give separately these details or the aging for projects in progress and projects temporarily suspended. And these are required to be given for each project separately. So further, the breakup needs to be given for CWP for a period of less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. So then, so with this, I mean, the regulator or the stakeholders will come to know that whether the CWIP is outstanding, I mean, the project is in progress for more than 2 years or 3 years, whether it was worth or it was required to be kept, or whether any impairment is required to be provided, or the CWIP actually got capitalized, actually has been put into place, however, it has not been capitalized in the books of accounts. So through this, it can be easily traced or identified that in those cases, if it is already put to use, but still not considered as a part of PP and considered as a part of CWIP, and pursuant to that depreciation is not provided or amortization is not being done, then it will be easily known, and to that extent, the impact will be there in the financial statement, either by virtue of depreciation, impairment, or amortization. Further, if projects are temporarily suspended, I mean, that will also give the fact to that regard whether any impairment provisioning is required to be done for that particular matter or not. So for capital work in progress, intangible assets whose completion is overdue or has exceeded its cost. Again, here it's very important for the management and for us as an auditor when we are auditing any company's financial statement, that if the so first we need to see the detail from the management. If CWIP is there, what was the plan of the management, within what timeline that CWIP was required to be considered completed, what was the capital commitment which was disclosed in the earlier period if it is being carried out from the earlier period in the financial statement. So the management will now have to share with the auditors, and they have to present in the financial statement that what is the original plan for its completion, and whether it has been overdue and the cost has been increased to that extent. Then further, I mean, there's a need for disclosure in the financial statement as per the requirement of amended Schedule 3. It says that the overdue projects are required, the details for overdue projects are required to be given in this manner, to be completed in less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. So again, this is required to be given as per project. And details of projects where activity has been suspended shall be given separately. No reporting requirement on this particular matter in CARO 2020. Revaluation of PP and intangible assets. Again, if we see on the left hand side, earlier there was a simple requirement to give the reconciliation. Now additionally, the requirement is this, that reconciliation of amount of change which is arising due to revaluation, and the change can be increase or decrease both. I mean, it's a sometimes it's a perception, wrong perception. The change means only increase. Change can be either increase or decrease. So if the change is of more than 10%, then the disclosure is required to be given. It needs to be presented separately. However, we should be very clear, and we should understand this, that this is the requirement of Schedule 3, whereas as per AS 10, which was there or which is there in existence even prior to this amendment, requires that entity to disclose the entire change in the net carrying value of each class of PP. So the entire change is required to be given. So the 10% criteria is not applicable here, whereas the Schedule 3 requires 10% criteria. So irrespective of 10% criteria, still we are supposed to give the entire set of change in the financial statement on account of revaluation, which can be even for 7% or 8% because it is required pursuant to the accounting standard requirement. Further, the company shall also disclose whether the revaluation is based on the valuation by a registered valuer or not. So as we know now, there are standards on valuation which are issued by ICI, and a valuer is required to be registered, and only a registered valuer can give a valuation report in certain cases. So the Companies Act required that when you seek valuation, it should be the valuation should be from a registered valuer. It should not be from an unregistered valuer. So the disclosure is required to be given in the financial statement now when there is a revaluation, whether that revaluation has been carried out by a registered valuer or not. That fact should be disclosed. And on similar line, there is a reporting requirement in CARO 2020 for PPE and intangible assets. Loans and advances, the present requirement which is there on the left hand side was a simple disclosure requirement. Loan receivable considered good, secured, unsecured, doubtful. Again, in case of doubtful, it is required to be split between secured and unsecured. So अगर हम लोग वहाँ देखेंगे तो secured, unsecured, doubtful का ही disclosure requirement था, और related party disclosure के हिसाब से हमें disclose करना पड़ता था कि अगर ये कोई party related parties में fall कर रही हैं तो उनकी details भी हमें देनी पड़ती थी. Now, as per the amendment which is carried out in Schedule 3, we are supposed to give additional disclosure requirement. That I mean, it says that related. So here the related parties again should be the related parties which are defined under the Companies Act 2013. So, for example, when we say Division 1, in case of Division 1, Accounting Standard 18 does not cover a director which is a non-executive director or independent director as a related party. I mean, that is covered as a related party in case of Ind AS. However, if we see the definition of related party as per Companies Act, a director will be considered as a related party. I mean, even if the director is a non-executive director, will be considered as a related party. So this is very important that here this disclosure requirement is required to be considered as per the definition of related party given under the Companies Act 2013. So the disclosure requirement here is that the amount has been given to whom? Promoters, directors, KMPs and related party, an amount of loan or advance in the nature of outstanding, and percentage of total loans and advances in the nature of loans. So if the loans are given without specifying any terms or period of repayment, or if the loans are repayable on demand, and only in these two scenarios, these details are required to be given with regard to related parties. And they have split it between promoters, directors, KMPs and related party. And related party other than these three can be like, for example, subsidiaries, associates, JVs, etc., which may not fall under the first three criteria, that is promoter, director, KMP. So this is very important for us to remember. And this is again good coverage in the Schedule 3 financial statement. Similar reporting requirement is there with regard to this particular matter in CARO 2020. Trade receivables, if we see on the left hand side, I mean, again, earlier it was a simple disclosure. I mean, if we compare as compared to the present disclosure, which is required to be given in the financial statement, earlier it was simply required to be given as considered good, secured, unsecured, doubtful, etc. And then doubtful will be further segregated between secured and unsecured as required. Whereas now the trade receivables are required to be considered or segregated between undisputed, considered good, undisputed, considered doubtful, and then disputed, considered good, and disputed, doubtful. So this is a massive exercise which management has to do. And here the disclosure is required to be given for a period of less than 6 months. So the aging has been broken up into 4 buckets. The first bucket, that the trade receivables which are outstanding for less than 6 months, 6 months to 1 year, 1 to 2 years, more than 2 to 3 years, and more than 3 years. So sorry, I mean these are 5 buckets, not 4 buckets, 5 buckets. So these are very important, and this has to be given for the current financial year. So when we go for the previous financial year, it will be like 1 plus 3 for 4 financial years. So this bucket will be given for the 4 years prior to the previous financial year. So with this particular disclosure, I mean, again, the regulator will come to know, or the stakeholders will come to know whether there are actual receivables. If there are actual receivables and they are undisputed, then if they are shown as outstanding for more than 2 years or more than 3 years, how is it possible? I mean, then as an auditor also one should question that if it is shown under first category, that is undisputed trade receivables considered good and which are outstanding for more than 3 years. I mean, it doesn't seems appealing. The auditor should look into that fact. I mean, apparently, by looking into the financial statement, there can be some analytical thoughts, and that will ease out the audit process also on the part of auditor. And this will also give good comfort to the stakeholders that the trade receivables are recovered on a regular basis in case if they are undisputed, and in case if they are disputed, how they are getting recovered, or what is the aging requirement for their outstanding period. And similar disclosure requirement should also be given in case no due date is prescribed. So the due date should be the due date which is prescribed in the invoice. If there is no due date prescribed, then it should be from the date of transaction which is recognized in the financial statement. And unbilled dues now should be disclosed separately. There is no reporting requirement in CARO 2020 with regard to this particular point. Borrowing, so if we see the new requirement of Schedule 3 says that if borrowing is obtained on the basis of security of current assets, so where the company has borrowing from banks or financial financial institutions on the basis of security of current assets, it shall disclose the following. Friends, please थोड़ा सा ध्यान रखिएगा, यहाँ पे लिखा है on the basis of security of current assets. So अगर नॉन करंट एसेट्स के बेस पे अगर लिया है तो ये क्लॉज की रिपोर्टिंग रिक्वायरमेंट नहीं आएगी, डिस्क्लोजर रिक्वायरमेंट नहीं आएगी. But if it is based on the security of current assets, then the company should disclose. And here it says borrowings. Borrowings will include all the borrowings, not like short-term, long-term, term loan, working capital, etc. It will cover all the borrowings and only those borrowings which are taken from banks or financial institutions. And again, which is based on the security of current assets. Then the disclosure requirement is this, that in case if the quarterly statement or return which is required to be filed by the company with banks or financial institutions are in agreement with the books of accounts or not. And if not, the summary of reconciliation is required to be given, and that tabular disclosure requirement is described here. So यहाँ पे ये requirement है. So as you all know कि अगर कोई company bank या financial institution से loan लेती है, they are supposed to give the maybe monthly, bi-monthly, quarterly statements or returns with those entities about the relevant assets which are on the basis of which the company has taken a loan. Now, as an auditor in the past, we normally see that year-end पे सारे compliances हुए या नहीं हुए, वो सारे sync में है या नहीं है, then it is fine. But if in between, if the company has given a different statement to the bankers or the financial institutions, and which are not in the sync with the financial, the books of accounts, it was not getting tracked. Now, because of this particular reporting requirement, this will get tracked. This is very, very important. So here now, in case of Division 1, this will, this can be easily identified or it can be easily known. For example, a entity which is required to prepare its financial statement as per Division 1, and it is giving to its company which is preparing its quarterly results for the purpose of consolidation, which is maybe, which may be based out of India or within India, then quarterly figures will demonstrate what are the figures of those current assets in the financial statement, which are either reviewed or audited by the auditor. And normally the review or the audit will happen somewhere after the end of the quarter, maybe after 15, 20, or 25 days. There will be some amount of time which will be taken by the management and auditor to close on those figures. And in the meantime, there may be a possibility that the requirement of the banker or the financial institution will be to have these details by maybe first week of the subsequent quarter. So अगर 30 June है तो maybe 1 July तक वो details उनको देनी रहेगी. अगर वैसा होता है तो obvious है कि जब वो 1 July को first week of July में details देंगे, that will be based on unaudited accounts, whereas when it will be reviewed or audited, उसमें figures में changes होने की probabilities high है. So अगर वो होता है तो there is a clear cut evidence that there is a discrepancy, and then that discrepancy is required to be disclosed in the Schedule 3 financial statement. Though the discrepancies might not be material, but that will be captured here in this particular tabular disclosure. So disclosure का requirement क्या है? We'll quickly run through. किस period का है? You should give the detail that it is for which quarter, name of the bank, Particulars of security provided, whether it is based on trade receivables, loans, inventories, etc. Amount as per books of accounts, amount as reported in the quarterly statement. यानी कि आपकी books of account में क्या, for example books of accounts में आपने trade receivables 100 crore के दिखाए हैं, but आपने quarterly return में आपने दिखाया है कि 125 crore है, 120 crore है. Maybe आपने कुछ revenue overlap हुआ होगा as of the last date of the quarter, which got postponed to the subsequent quarter once the financials were reviewed or audited, or there may be some write-off. So in that case, there will be a discrepancy. The amount of difference is required to be given and reasons for material discrepancies. Here, friends, again, we need to understand in case of real estate company, what will happen. In case of real estate company, they will have inventory. So if a real estate company will take a loan on the basis of inventory, should it be considered here for reporting requirement or not? I mean, as per my view, it should be, because inventories are part of the current assets in case of real estate. Though inventories are in the nature of immovable property, but they are in the nature of current assets for real estate. And here the reporting requirement is that if the loans are, if the amounts are borrowed on the basis of security of current assets. So in case of real estate, when the amount have been borrowed on the basis of immovable property, this will get captured. Whereas in case of other companies where the amounts have been borrowed on the basis of immovable property, where the immovable properties are held as investment property or PP, then this clause will not get triggered, because these assets will be in the nature of non-current assets. So this is very important criteria or important aspects which one should remember. The disclosure required on this clause should be made where borrowings have been availed on the basis of current assets of other companies or entities within the same group as the reporting entity. So if it is based, if the so the guidance note says that if the borrowings have been made or availed on the basis of current assets of other companies or entities within the same group, then also the reporting requirement is getting triggered. So it is not only कि आपको खाली अपनी ही कंपनी की सिक्योरिटी ऑफ करंट एसेट्स पे देखना है. अगर आपकी कोई ग्रुप एंटिटी है, and group entities are very wide term, it's not only subsidiary, associate, JV, I mean it will be higher than that. So one should evaluate कि अगर वहाँ उस बेस पे अगर कहीं पे फंडिंग हुई है तो वो भी यहाँ पे रिपोर्टिंग रिक्वायरमेंट आएगा. Simultaneously वो related party की disclosure में भी आएगा as per AS 18 or Ind AS wherever it is getting triggered. And similar reporting requirement on this particular clause is also there in CARO 2020. And use of borrowings. So where the company has not used the borrowings from banks and financial institutions for a specific purpose for which it was taken at the balance sheet date, company shall disclose. So अगर जो एंड यूज नहीं हुआ है जिस पर्पस के लिए लिया है तो वो आपको अभी डिस्क्लोज करने की रिक्वायरमेंट है. ये पहले कारो में था, अब ये शेड्यूल 3 में भी आ गया है, ये डिस्क्लोजर रिक्वायरमेंट है. सिक्योर डिपॉजिट्स के अंदर क्या अमेंडमेंट हुआ है, वहां पे द अमेंडमेंट इज देयर दैट earlier security deposits were shown as a part of long-term loans and advances. Actually if we see, it is not in the nature of loans and advances. So now this has been rectified to that extent when the amendment has been carried out in schedule 3. Now it is added as a part of other non-current assets. Utilization of borrowed funds and share premium. So this clause requires, or this amendment in schedule 3 required that if the company has advanced or loan or invested funds which are either through borrowed funds or through share premium. I mean, if the company has issued some shares and security premium amount has been received, and the funds have been given to any other person, including foreign entities, with an understanding that the intermediary shall directly or indirectly lend or invest in other person or entities identified in any manner whatsoever by or on behalf of the company. यानी कि फर्दर अगर फंडिंग करनी है, आपने पास थ्रू की तरह लिया, आपने यहाँ लिया, यहाँ से आगे दे दिया, या अगर उस तरह से किया, or to provide any guarantee or security on behalf of ultimate beneficiaries, then in that case the company should give the information in the tabular manner which is described here. So disclosure में ये देना है funds advance or loan or invested in intermediaries, डेट के साथ देना है कब दिया है और क्या अमाउंट का दिया है, fund further advance or loan and guarantee security or the like provided to on behalf of the ultimate beneficiary. On the similar lines, there is a reporting requirement in CARO 2020. Utilization of borrowed funds and share premium. So where a company has received, so ये पहले वाला clause था जहाँ पे था कि advance है, यहाँ पे received है. So on similar line अगर आपने पैसा लिया है और आपने लेकर किसी को दे दिया है, तो then also it requires to give disclosure in this particular manner, in the tabular manner for the required criteria. Details of a Benami property held. Again, this is a very relevant topic for the regulators. So पहले regulators were not able to fetch कि अगर किसी के पास बेनामी property है या नहीं है. So with many of the amendments, the government has tried to capture the information in the financial statement so that they can very easily understand, and they have considered auditors as the first point of contact which can identify this, and they presume that auditors will be able to fetch all the required information and which auditors should fetch from the management, and then based on that the adequate disclosures are required to be given. So this will make work smoother for the government, and a lot of amendments have been carried out in Schedule 3 based on the recent past where some of the collapse happened in some of the large groups in NBFCs or other companies. So by having learning from those recent developments, government has tried to capture amendments in the Schedule 3. So this is also one of them. So यहाँ पे अगर हम देखेंगे बेनामी प्रॉपर्टी, अगर कंपनी के पास में कोई बेनामी प्रॉपर्टी है तो गवर्नमेंट वांट्स ऑडिटर टू डिस्क्लोज दिस. So details. So what are the details which are required to be given? So Benami property will be as defined in Benami Transaction Prohibition Act, and the company should give these kind of disclosure: details of such property, year of acquisition, कब खरीदा था, क्या amount है, details of beneficiaries, if property is in the books, यानी कि अगर books में है तो डिटेल देनी है, books में नहीं है तो भी देनी है, और उसके reasons देने हैं. सो फ्रेंड्स ये आप जरूर ध्यान रखिएगा, ऐसा नहीं कि आपकी रिस्पॉन्सिबिलिटी यहाँ खत्म हो जाती है एज एन ऑडिटर कि बुक्स में दे दिया बात खत्म हो गई. मैनेजमेंट शुड ऑल्सो अंडरस्टैंड कि बुक्स में अगर नहीं है बट अगर बेनामी प्रॉपर्टी है एंड इफ इट इज नोन तो आपको वो दिखाना पड़ेगा, और उसके दूसरे रिपरकशंस होंगे जो मैनेजमेंट और ऑडिटर को लेने पड़ेंगे कि अगर वो बुक्स में नहीं है तो क्यों नहीं है. And where they are proceeding against the company under this law as an abettor of the transaction or as the transfer, then the details shall be provided. And nature of proceedings, status of same and company's view on same. So company के ऊपर क्या proceedings हैं उन सबकी details देनी रहेंगी. इसी लाइन पे similar reporting requirement है कारो 2020 के अंदर. Ratios ये बहुत ही important है. ये ratios अब इस साल से देने पड़ेंगे with the comparative period also. And these are the minimum ratios which are prescribed in Schedule 3. So the ratios are like current ratio, debt equity ratio, debt service coverage ratio, return on equity ratio, inventory turnover ratio, etc. And it's very important. I mean, these ratios will give first-hand information to the lenders, stakeholders, and regulators or tax authorities about the financial portion of the company, which many times apparently not visible. Now this will be like a cooked food, मतलब खाना परोसते हैं वाली बात है, which will be making lives easier for the external party to understand the financial position of the company. So इसी financial ratios के ऊपर कुछ matters के ऊपर कारों में भी कमेंट करना है. तो कारों में वहाँ ये रिक्वायरमेंट आ जाएगी कि भाई लिक्विडिटी पोजीशन क्या है, तो उस लाइन के ऊपर रेशियोज कवर करने की नेसेसिटी है. अदरवाइज रेशियोज के ऊपर कोई स्पेसिफिक कमेंट नहीं है कारो 2020 में. However, the Schedule 3 amendment has not prescribed that what should be covered in denominator or numerator, but the regulator requires that whatever you cover as a part of numerator or denominator, that should be adequately disclosed in the financial statement. यानी कि हर रेशियो के लिए आपने जो भी न्यूमरेटर और डिनोमिनेटर कंसिडर किया है वो आपको डिस्क्राइब करना है कि उसमें आपने क्या कैप्चर किया है, क्या क्या मैटर्स कवर किए हैं जिसके बेस पे रेशियो आ रहा है, तो पूरा आपको फॉर्मूला और डिस्क्रिप्शन देना रहेगा. और दी रेगुलेशन रिक्वायर्स कि अगर रेशियोज में कोई भी चेंज है, अगेन चेंज मीन्स आइदर प्लस और माइनस ऑफ मोर देन 25% इज कंपेयर्ड टू प्रीसीडिंग ईयर, तो एक्सप्लेनेशन या रीजनिंग देने की नीड है, ये आपको करना पड़ेगा, विच इज वेरी इंपॉर्टेंट. Now we'll come to the profit and loss account requirement. So profit and loss में क्या requirement है? CSR के अंदर एक major change आया है reporting requirement के तौर पे. पहले CSR के लिए reporting requirement was not mandatory as per the requirement of Companies Act 2013. There was a technical guide on CSR which was issued by ICI that was requiring. So there were arguments from many corporates in the past कि ये तो technical guide है, mandatory nature नहीं है. कंपनीज एक्ट नहीं कहता है, कंपनीज एक्ट डिस्क्लोजर कहता है एनुअल रिपोर्ट में दे दिया हमने, वहां दे देंगे, नोट्स टू अकाउंट्स में देने की जरूरत नहीं है. बट अब ये अमेंडमेंट के चलते आपको नोट्स टू अकाउंट्स में कंपल्सरीली देने पड़ेंगे. सो अर्लियर आल्सो मेनी कंपनीज आर गिविंग इट एज अ पार्ट ऑफ गुड कॉर्पोरेट गवर्नेंस, बट अभी कंपल्सरीली देना है. आइदर द मैनेजमेंट एग्रीज और नॉट, बट दीज डिस्क्लोजर्स आर रिक्वायर्ड टू बी गिवन मैंडेटली इन दी नोट्स टू अकाउंट्स ऑफ द फाइनेंशियल स्टेटमेंट. सो अगर अगेन हम लोग लेफ्ट साइड में देखें तो एग्जिस्टिंग रिक्वायरमेंट क्या थी. एग्जिस्टिंग रिक्वायरमेंट एज पर टेक्निकल गाइड थी 1 2 3 4, ये 4 पैरामीटर्स के ऊपर जो डिस्क्लोजर देने थे. नाउ इन एडिशन टू दैट दिस एडिशनल रिक्वायरमेंट, की एडिशनल रिक्वायरमेंट में ये है कि कंपनी को कितना खर्चा करना है, कितना खर्चा कंपनी सीएसआर के लिए कर चुकी है, शॉर्टफॉल कितना है, प्रीवियस ईयर्स का शॉर्टफॉल कितना है वो भी देना है, उनका शॉर्टफॉल का रीजनिंग देना है. तो सीएसआर के लिए एज वी ऑल नो कि 3 इयर्स के प्रॉफिट के बेस पे भी वर्कआउट की कितना खर्चा होना चाहिए. तो वो अगेन दिस इज वेरी इंपॉर्टेंट फॉर द ऑडिटर टू अंडरस्टैंड एंड टू इवैल्यूएट दैट दिस इज प्रॉपर्ली कॉम्प्यूटेड, एंड बेस्ड ऑन दैट इट नीड्स टू बी लेड अपॉन कि ये सारे फिगर्स अप्रोप्रिएटली डिस्प्ले हो रहा है नहीं हो रहे हैं, उसके सामने उतना एक्सपेंस हो रहा है नहीं हो रहा है. So this is again a good initiative from the government side to track and see that those companies who are generating profit, they are supposed to incur some cost in the nature of CSR, and if it is not incurred, then it is adequately disclosed. Though CSR is still not mandatory in nature, but these disclosures are mandatory in nature. Reason for shortfall, nature of CSR activities, details of related party transactions. Now, I mean, it has been made mandatory in that sense that if you don't incur the cost in totality, what you are required to incur, then you will have to transfer the deficit to the fund which is owned by the government. I mean, the prescribed fund. So indirectly, it become mandatory. आपको खर्चा करना ही पड़ेगा. अगर आप नहीं करते हैं तो आपको वहाँ पे ट्रांसफर कर देना पड़ेगा. Or in case the last thing where a provision is made with respect to liability incurred by entering into contractual obligation. So अगर CSR, अगर आप मान लो कि बहुत से large corporates होते हैं जहाँ पे so for example Reliance हो गया या बिरला ग्रुप हो गया, कोई भी ग्रुप हो गया जहाँ large groups होते हैं, they have their own foundation or they have their own trust who will incur the cost on behalf of the group as a part of CSR initiative. So those SPVs of the group will transfer the amount to that foundation or the trust who ultimately will incur the expenditure. तो जब वो CSR का expenditure होगा तो if it is happening in that way, then that foundation or trust will be falling in the category of related party. तो जब वो related party होगा तो यहाँ second last column जो depict किया गया है वो ये कहता है कि वो related party के तौर पे यहाँ specify करना पड़ेगा कि आपने इतना amount इस तरह के fund या trust को दिया है जो related party की definition में fall करता है. Further, as per the guidance note on Schedule 3, the company should also disclose the following: the shortfall amount in respect of the other ongoing projects transferred to a fund or to a special fund. और अगर अनस्पेंड अमाउंट है तो उसके ऊपर कारो 2020 में रिपोर्टिंग रिक्वायरमेंट है. अगर स्पेंड है तो कोई इशू नहीं है, अगर अनस्पेंड है तो रिपोर्टिंग रिक्वायरमेंट है. अगेन यहाँ पे काफी इंपॉर्टेंट है कि आपको ध्यान रखना पड़ेगा. अब इस नई रिक्वायरमेंट के हिसाब से अगेन विद द अमेंडमेंट इन द प्रोविजंस ऑफ CSR अंडर द कंपनीज एक्ट 2013, if the amount is not incurred by the company is required to transfer the deficit in a separate escrow account within a period of 30 days from the end of the financial year. So कुछ company as a part of good governance 30 days के पहले भी कर देती है. So maybe like 30th March or 31st March. You should remember अगर वो separate escrow account में है which is for CSR purpose, तो in the cash flow statement or in the financial statement it will not form part of cash and cash equivalent because it is earmarked. वो अदर बैंक बैलेंसेस में चला जाएगा और अगेन वहां पे सेपरेट डिस्क्लोजर देना पड़ेगा कि ये ईयरमार्क फंड है, क्योंकि वो आपके लिए इवन दो करंट अकाउंट में है बट वो आपके लिए अवेलेबल नहीं है, वो लिक्विडिटी के तौर पे आप यूज नहीं कर सकते हैं. ईयरमार्क फॉर CSR है वो वहां चला जाएगा. सो इट विल नॉट बी फॉर्मिंग पार्ट ऑफ कैश एंड कैश इक्विवेलेंट. दिस इज वेरी इंपॉर्टेंट अगेन फॉर वन टू रिमेंबर एंड वन टू लर्न दैट इन चीजों के इम्प्लीकेशंस बाकी जगह पे क्या होंगे. नाउ इन केस ऑफ P&L में फेस पे क्या चेंज हुआ है? माइनर चेंज है. टोटल रेवेन्यू की जगह टोटल इनकम फ्रेज वर्ड यूज कर दिया गया है. सो रेवेन्यू डिलीट कर दिया है. पहले खाली रेवेन्यू फ्रॉम ऑपरेशंस और अदर इनकम आता था, उसके बावजूद नीचे टोटल रेवेन्यू लिखते थे तो कंफ्यूजन रहता था. अभी टोटल इनकम कर दिया और हमने जैसे पहले देखा राउंडिंग ऑफ का क्राइटेरिया टोटल इनकम के बेस के पे है. सो नाउ इट इज वेरी इजी टू नो दैट दिस इज द टोटल इनकम और टोटल इनकम का होराइजन बढ़ा दिया है. पहले वो टर्नओवर के बेस पे था राउंडिंग ऑफ का क्राइटेरिया, अब इनकम के बेस पे और अब मैंडेटरी है. सो दिस इज वन ऑफ द इंपॉर्टेंट चेंज ऑन द फेस ऑफ द P&L. एंड रेवेन्यू फ्रॉम ऑपरेशंस विल आल्सो कवर ग्रांट और डोनेशन. मोस्टली ये जो सेक्शन 8 कंपनीज है उनके लिए रेलेवेंट है. अनडिस्क्लोज इनकम, अगेन फ्रेंड्स ये बहुत ही इंपॉर्टेंट क्लॉज है. पहले काफी बार ऐसा होता था कि किसी भी कंपनी के ऊपर सर्च या सर्वे होता था, कंपनी इनकम डिस्क्लोज कर देती. हमने देखा होगा काफी बार कि कंपनी ने इनकम डिस्क्लोज कर दी और वो जो इनकम डिस्क्लोज की है, सो फॉर एग्जांपल इफ वी आर ऑडिटिंग फाइनेंशियल ईयर 21-22, इस ईयर में सर्च या सर्वे हुआ है और वो हुआ है शायद फाइनेंशियल ईयर 15-16 या 16-17, बट वो इनकम कभी बुक्स में दिखाई नहीं गई थी. इवन इन दो सिनेरियोज इन अर्लियर पीरियड्स, अगर सपोज ये पहले वाले साल में हुआ होता तो भी आपको उसकी अकाउंटिंग करने की रिक्वायर्ड थी, नेसेसिटी थी, क्योंकि वो अनडिस्क्लोज इनकम है. अगर आज मैनेजमेंट ने सामने से जाकर वॉलंटरी एडॉप्ट कर लिया है या सर्च या सर्वे के अंदर उन्होंने एक्सेप्ट कर लिया कि हाँ मेरे पास इतना इनकम था, तो कहीं ना कहीं वो बुक्स में आना चाहिए क्योंकि उसके ऊपर टैक्स लगा है. तो पास में भी वो रिक्वायरमेंट थी एज पर द अकाउंटिंग स्टैंडर्ड, but there were debates, deliberations, many managements were not keen to show it as a part in the financial statement. They were saying कि ये तो ऑफ बैलेंस शीट है, तो निकल जाएगा, ये हमें ऑन बैलेंस शीट कहीं फाइनेंशियल्स में लाने की जरूरत नहीं है. बट अब इस अमेंडमेंट के थ्रू अगर ऐसा कुछ हुआ है तो there is a need to disclose that such kind of transactions were not recorded in the books of accounts which are now surrendered, and now there is a need to disclose it as an income. Any transaction not recorded in the books of accounts that has been surrendered or disclosed as income during the year under the ITI, unless there is immunity for disclosure. अगर कोई immunity है तो ठीक है, नहीं तो फिर वो देना पड़ेगा. And shall also state that whether previously unrecorded income and related assets have been properly recorded. यानी कि अब आपको ये भी डिस्क्लोज करना पड़ेगा कि आपने कितना डिस्क्लोज किया है सर्च सर्वे में जो पहले नहीं था, और अब उसको आपने अकाउंट फॉर किया है कि नहीं है, कि अब आपने उसको P&L बैलेंस शीट में फैक्टर किया है कि नहीं. सो पहले की तरह नहीं कि आउट ऑफ द बुक्स निकल गया और रीडर ऑफ द फाइनेंशियल स्टेटमेंट को पता ही नहीं चला कि आपके सर्वे में क्या इम्पैक्ट है. खाली एक फिगर टैक्स का आता था, वो बुक्स में इम्पैक्ट आता था, विच इज नॉट करेक्ट, विच इज अ बिगर चेंज नाउ. इस पे कारो 2020 में कोई रिपोर्टिंग रिक्वायरमेंट नहीं है. क्रिप्टो करेंसी, अगेन क्रिप्टो करेंसी और वर्चुअल करेंसी के अंदर गवर्नमेंट काफी कीन है टू ब्रिंग आउट दी रिपोर्टिंग रिक्वायरमेंट्स, ट्रांसपेरेंसी एंड लेजिस्लेशन. यहाँ पे क्रिप्टो करेंसी और वर्चुअल करेंसी के लिए गवर्नमेंट ने कहा है आपको डिस्क्लोज करना है कोई अगर प्रॉफिट लॉस हुआ है उन ट्रांजेक्शन से, अमाउंट ऑफ करेंसी हेल्ड एज रिपोर्टिंग डेट, अगर आप कुछ होल्ड कर रहे हैं क्रिप्टो करेंसी या वर्चुअल करेंसी के थ्रू, और डिपॉजिट्स और एडवांसेस. ये सब में आपको ऑडिट प्रोसेस काफी स्ट्रॉन्ग रखने पड़ेंगे. आपको मैनेजमेंट से समझना पड़ेगा, MRLP लेनी पड़ेगी, आपको बैंक स्टेटमेंट्स देखने पड़ेंगे कि ट्रांजेक्शंस कैसे हो रहे हैं, कहाँ से हो रहे हैं. सो थ्रू दैट ओनली यू विल बी एबल टू आइडेंटिफाई कि कंपनी के पास क्रिप्टो करेंसी या वर्चुअल करेंसी है या नहीं है. Other additional disclosures, willful defaulter. Willful defaulter कंपनीज एक्ट में अभी डिस्क्राइब किया गया है. I mean, इस सेंस में डिस्क्राइब किया गया कि वेयर कंपनी इज डिक्लेयर्ड willful defaulter. सो willful defaulter कब होगा? अगर willful defaulter तब होगा जब आपको कब ट्रिगर होगा? आपको तब ट्रिगर होगा कि अगर कंपनी के लोन्स के रिपेमेंट में डिफॉल्ट हो रहा है. अगर कंपनी के लोन्स में रिपेमेंट में डिफॉल्ट हो रहा है, देन यू शुड सेंस इट, यू शुड आस्क टू द मैनेजमेंट कि ये willful defaulter की कैटेगरी में कंपनी फॉल हो रही है नहीं हो रही है. अगर सीवियर डिफॉल्ट है तो, नॉमिनल डिफॉल्ट है तो ठीक है, सीवियर डिफॉल्ट है तो, एंड देन एज अ पार्ट ऑफ ईयर एंड प्रोसेस एज एन ऑडिटर आप कंफर्मेशंस मांगते हैं बैंक से कि क्लोजिंग बैलेंसेस कितना है, FD कितना है, गारंटी कितना है. उसके अंदर एज एन ऑडिटर आपको ये कहना चाहिए और आपको इंक्लूड करना चाहिए दैट बैंक शुड confirm that the company is a willful defaulter or not, which has been identified with the bank or financial institution. ये आपकी रिस्पॉन्सिबिलिटी को डायलूट कर देगा. अगर बैंक नहीं कहता है दैट इज फाइन, बैंक कहता है कि कंपनी विलफुल डिफॉल्टर है तो फिर आपको ये डिस्क्लोजर देने पड़ेंगे जो रिक्वायर्ड है. और विलफुल डिफॉल्टर ये है, it means a person or an issuer who or which is categorized as a willful defaulter by any bank or financial institution or consortium thereof. So अगर वो उन्होंने आइडेंटिफाई किया है और ये अगर आप कंफर्मेशन प्रोसेस के थ्रू मांगेंगे तो आपको इजीली मिल जाएगा. दिस विल ईज आउट योर प्रोसेस टू आइडेंटिफाई, टू डॉक्यूमेंट इट and to bring out the disclosure in line with the requirements with this particular clause. And on similar line, there is a reporting requirement, CARO 2020. Register of charge or satisfaction of charge with register of companies. So अगर charge satisfy नहीं हुआ है या charge create नहीं हुआ है तो उसकी details भी देने की need है, which was not there earlier. So many companies may not create charge on the assets which they pledge or hypothecate with the lenders. Now with this, there will be reporting requirement, and once you create a charge, this comes into the public domain. Anyone can just go to the MCA portal and can verify कि charge has been created on not on those assets, and this will help the lenders to get defrauded by giving loan on the same asset which has been already pledged by the company with some another lender. And if the charges, and here one again important thing to know that the charge is required to be created as per the Companies Act 2013 on movable and immovable properties both. Earlier under Companies Act 1956, the charge was required to be created only on immovable property, but now it covers movable property also. So for example, fixed deposits. So काफी time we have seen that fixed deposits are given as a lien or so. So if that is given, then if there's a need to create a chart, the chart should be created. If it is not created, it is required to be reported. Compliance with number of layers of companies. The number of layer of companies has been now restricted to 2, which we have discussed, or which we come to know in our today's earlier session, which was described by Aleem also. So now there are only 2 layers of companies for the requirement of Companies Act 2013. 2 wholly owned subsidiaries can be there. If there are more than 2, then the disclosure requirement is there, and adequate disclosure should be made with regard to that. And on similar line, there's a reporting requirement in CARO 2020. Relationship with stock of companies. Again, this is very important. If there are any transactions which are there, which are carried out by the company with the companies who are struck off under Section 248, then the disclosure is required to be given. As an auditor and as a management, management should be vigilant to identify these transactions, the companies which are struck off, and then the transactions carried out with them. So here each ROC, just to make a point here, each ROC comes out with a list of those entities which are struck off by that respective ROC, and they issue a public notice in the nature of Form STK 7, which is displayed on the MCA portal. So from there the detail can be fetched, and then the company or the auditor should verify कि ये इनमें से कोई कंपनी स्टॉक ऑफ कंपनी में फॉल हो रहा है कि नहीं हो रहा. अगर है तो उनके साथ के क्या ट्रांजेक्शंस हैं और वो बैलेंसेस आउटस्टैंडिंग है, उनकी रिलेशनशिप क्या है. This is very important. There is no reporting requirement in CARO 2020 with regard to this matter. Compliance with approved schemes of arrangement. So earlier the disclosure was required to be given only with regard to AS 14 or Ind AS 103 for business combination. Now there is a specific need to make a statement in the Schedule 3 of the financial statement that the scheme approved by the competent authority have been, discloses the effect. The scheme which has been approved by the competent authority has been accounted adequately in the financial statement, and then such scheme is in such accounting is in accordance with the scheme, and it is in accordance with the accounting standard. So there may be a possibility that any scheme which is approved where there have been some deviation with the accounting standard, or there have been some changes between the auditors. Earlier auditor has approved or has given a certificate that the scheme is in compliance with accounting standard. So now it is required that when the scheme is being approved, the certificate has to be given by the auditor that it is in compliance with the accounting standard. But if the auditor is changed, maybe by virtue of rotation or by virtue of resignation, and the new auditor comes up, and when the scheme is getting approved, and if he finds out that there is a deviation with regard to the accounting standards, then this is also required to be adequately disclosed. So 2 parameters are required to be stated in the notes. One, that the accounting has been done in accordance with the scheme, and the scheme is in accordance with the accounting standard. Further, if there is any deviation, the explanation should be given with regard to that fact. And the important thing guidance note also says that if there have been any earlier scheme which has been approved by the regulator and which has an ongoing impact on the current financial year or the comparative financial year, then even with regard to that, there is a need to make a statement. So for example, if we are in the financial year 21-22 and in financial year 18-19, one scheme of merger was approved under AS 14, and a goodwill was recognized, and goodwill is getting amortized over a period of 5 years. So when this got effective or with effect from appointed date in 18-19, goodwill will still be there in the current financial year if it is getting amortized over a period of 5 years. Then in that case also, though the scheme was approved in 18-19, the effect was given in 18-19, the comment is required to be made in the financial statement of 21-22 because that scheme is having an ongoing accounting impact in the current financial year financial statement. There is no reporting requirement on this matter in CARO 2020. Statement of, so now we'll come to division 2, with this we are through with division 1 changes. Division 2 में अगर हम लोग देखेंगे more or less सारे changes in sync है जो division 1 के अंदर है. In addition to that, we have just covered the additional slides. So division 2 में statement of changes in equity में restated balance देना है जो prior period के तौर पे, और उनकी changes in equity capital देनी है, which is a nominal disclosure. अगर कुछ होता है तो वहाँ report करना पड़ेगा. On this there is no reporting requirement in Caro. Other equity में they have bring out a tabular statement कि आपको किस तरह से present करना है, क्या करना है. So this is a tabular statement. I'll not run through this. This is a factual in nature. So the disclosures are required to be given with regard to the respective heads of reserves and has to be presented accordingly here. In case of investment property, there is a requirement earlier, or the company was required to disclose the fair value of the investment property. Now they are also supposed to disclose that whether the valuation has been carried out by the registered value. जैसे हमने पहले देखा PPE के केस में, here also there is a need to make a statement that it has been fair valued by a registered value. No reporting requirement on this in Caro 2020. Phase of the balance sheet and in notes. अगर हम बैलेंस शीट के फेस में देखेंगे तो लीज लायबिलिटीज करके एक नया हेड ऐड हुआ है अंडर द हेड ऑफ नॉन करंट लायबिलिटीज. In case of current liabilities, again it has been presented as a lease liability. So as we know, ROU in case of Ind AS financial statement, Ind AS 116 is getting applicable, ROU is getting recognized, lease liabilities hai. Lease liabilities now are getting splitted between non-current and current and are required to be presented accordingly on the face of the financial statement. One important change to remember, in case of division 2, bank deposits which are outstanding for more than 12 months maturity, they are required to be shown as a part of other financial assets and not as a part of other bank balance. So अगर आप देखेंगे division 1 के अंदर वो bank balance का part होगा, but division 2 के अंदर more than 12 months maturity होगा तो वो bank balance का part नहीं होगा, वो other financial asset का part होगा. This is very important. And on all these matters described in this slide, there is no reporting requirement in Caro 2020. Friends, ये slides में I have just brought out the comparatives between Caro 2020 and Schedule 3 with regard to some of the key matters which are getting reported in Schedule 3 and Caro 2020 both. So this will ease out in terms of understanding. And on this matter, Institute has also come out with a write-up. Institute has also described the reconciliations between both these new regulatory requirements. So for first point, as we had seen, title deeds on immovable property, there is no differentiating requirement between Schedule 3 and Caro 2020. In case of PP revaluation, again, there is no deviation in terms of reporting requirement in Schedule 3 or in Caro 2020. Then in case of Benami property also, it is in line at both the places. In case of working capital, in case of funds borrowed on the basis of working capital, this is very important to remember. Here, in case of Caro 2020, working capital limits are required to be considered. I mean the borrowings which has been taken on the basis of working capital limit, whereas in case of Schedule 3, it covers all the borrowing. So if we see the remark column, Caro 2020 prescribes reporting requirement relating to sanctioned working capital limit in excess of 5 crore rupees in aggregate. So Caro 2020 में amount का भी specification दिया गया है और working capital के base पे दिया गया है. Whereas in Schedule 3, it is based on total borrowing. ये working capital नहीं है, so इसमें term loan वगैरह सब कुछ आ जाएगा, which is an exhaustive disclosure. So आप यहाँ देखेंगे दोनों clause में कहीं ना कहीं overlapping हो रही है. So in nutshell, both the clauses cover the entire gamut of the borrowings. और ऑडिटर को ये और मैनेजमेंट को इवैल्यूएट करना है कि कौन सी चीज कहाँ जाएगी इन शेड्यूल 3 एंड इन कारो रिपोर्टिंग. सो शेड्यूल 3 में इट्स बेस्ड ऑन बोरिंग, कारो में इट्स बेस्ड ऑन वर्किंग कैपिटल लिमिट्स. मॉनेटरी लिमिट है कारो में, शेड्यूल 3 में नहीं है, ये इंपॉर्टेंट फैक्टर है. कंपनी हैज ग्रांटेड एनी लोन्स, सो इस केस में शेड्यूल 3 में कारो में परसेंटेज ऑफ लोन की भी डिटेल सेपरेटली देनी है. And further, I mean, in Schedule 3 to the Companies Act 2013, loans and advances given to promoters, directors, KMPs, and other related parties are considered. Whereas in Caro 2020, if loans and advances are given to other than related parties, these will also get captured. So ये बहुत important है, ये ध्यान में रखिएगा. Caro 2020 में loans granted to all the parties will get captured, whereas in Schedule 3, it will cover only loans which are granted to related parties. In this clause, if we see term loans which were applied for the purpose of which loans were obtained, और Schedule 3 कहता है borrowings from banks and financial institution. So यहाँ कारो में अगर हम देखेंगे, again very important differentiating factor, रिपोर्टिंग ऑन टर्म लोन फ्रॉम एनी पार्टी, यहाँ पे हर तरह का बोरिंग, यानी कि अगर आपने ग्रुप कंपनी से भी लोन लिया है तो वो यहाँ पे कवर हो जाएगा कार 2025। मेरा शेड्यूल 3 कहता है बोरिंग्स फ्रॉम बैंक्स एंड फाइनेंशियल इंस्टीट्यूशन। सो ये डिफरेंशिएटिंग फैक्टर है, ये हमें थोड़ा ध्यान रखना पड़ेगा। यहाँ पे अगेन इन टर्म्स ऑफ रेशियोज इफ वी सी, वी हैव ऑलरेडी सीन इन अर्लियर स्लाइड्स, रेशियोज में कोई डिफरेंशिएटिंग फैक्टर नहीं है, बट अगर मटेरियल अनसर्टेनिटी है विद रिगार्ड टू the repayment of liabilities on the basis of financial issues, then a comment is required to be given in CARO 2020. Friends, with this, I am through with my presentation. I hope I could share whatever minimum knowledge which I had. It would be useful for all of you to understand and to make this get implemented in the financial statement in CARO 2020. Thank you very much. Thank you for your patience hearing. Happy to answer any questions. Over to you now, Arpit. Thank you. Hello. Am I visible? Am I audible? Hello. Hello.
Yes.
Yes,
Yes,
sir. Yes,
sir.
sir.
Hello.
Yeah.
Right. Mishra ji, if you could have more questions, please put up on screen. Bhavna, may I request you if you could take up these questions, please?
Yes, sir. So question for you, sir. Since we have to disclose the difference in stock as reported with bank versus books, what is meant by material difference? What could be the possible impact of the reporting of such difference?
So here, if we see, I mean, the requirement of Schedule 3 states that we should give the reasoning only for material differences. So आपको differences तो देने हैं, whether it is material or immaterial. But आपको जो reasoning देनी है, that should be given only for material differences. And again, material differences is very subjective in nature. But for identifying कि वो material है नहीं है, आपको अपना जो मेटिलिटी का ऑडिटिंग स्टैंडर्ड है आपको वो देखना पड़ेगा, उसके बेस पे आपको ये फैक्ट कैप्चर करना पड़ेगा कि ये मटेरियल है नहीं है, और अगर मटेरियल है तो आपको वहां पे रिमार्क देना है. सो आपको डिफरेंसेस तो देने ही देने हैं. यू आर नॉट गेटिंग exempted from giving differences in the differentiating figures, but reasoning देने में आपके पास ऑप्शन है. और इम्पैक्ट अगर मटेरियल है तो इम्पैक्ट डेफिनेटली है. इम्पैक्ट ये होगा कि देयर विल बी क्वेश्चंस फ्रॉम द लैंडर्स, देयर विल बी क्वेश्चंस फ्रॉम द एक्सटर्नल पार्टीज कि ये आपने हमें जो स्टॉक स्टेटमेंट दिए हैं या जो डिटेल्स दी हैं वो गलत है और जो आप अपने पास रख रहे हैं वो डिफरेंट है. एंड दिस विल इम्पैक्ट टू, आई मीन if there are genuine reasons, then the differentiating factors can be omitted, but if the reasons are not genuine, it may impact your borrowing requirement, borrowing covenants, or maybe rate of interest with the lenders. So this will be important to that extent.
Okay. Can we move on to the other question?
Please. I hope this answers to the candidate or to the audience who have asked this particular question. Please move on to the next question.
How to identify that company has made transactions in crypto, and what are the audit procedures for the same?
So, I mean, for all these amendments, Institute has come out with the guidance note, and they have very nicely covered up the processes which are required to be covered by the auditors. Here, a couple of processes which we as an auditor can cover during our audit process. We can see the details of the bank account. We can evaluate if there are any transactions, because if ultimately any transactions will happen, it will get routed through the bank account only. We can ask the questions from the management. We can document it by getting it signed off from the management side as a part of our inquiry process, which is being carried out during the audit activities. We can take the representation from the management, and wherever there is an audit committee, we can make a statement before the audit committee that we have relied on the representations with regard to this matter. And in addition to the processes which we have carried out with regard to identifying whether the transactions has been carried out by the management with regard to cryptocurrency or not. So I mean, these are the few processes which can be carried out by the auditor to know whether the transactions has been made with regard to cryptocurrency or virtual currency.
Okay. Third question: if CSR is not applicable to company and company has incurred CSR expenses, whether company can use the CSR expenses in future when CSR is applicable?
No. So here that set of provision as of now is not applicable. So if the CSR is not applicable to the company and though company has incurred the cost with regard to CSR matter, I mean that set of provision is not there, and the disclosure requirement will also not get triggered because CSR is not mandatorily applicable to the company by virtue of the provision of Companies Act 2013.
Okay. What should be the meaning of repayment of loan or repayment of interest in ratio of debt service coverage ratio?
What should be the meaning of repayment of loan or repayment of interest in ratio of debt service coverage ratio? I mean, these ratios which are prescribed in Schedule 3 are not giving the requirement of the numerator or denominator. The numerator or denominator company will have to identify. They will have to depict in the financial statement. Auditor will have to vet it, and based on that, the ratios are required to be given. So again, it will be. I mean, there is no sacrosanct reply for this. It can be varied between various companies till the time the coverage in numerator or denominator is not defined by the regulator or by ICA in guidance.
Okay. If small companies have not maintained stock register and have given inventory figures to bank without having supportings, how can we deal with such a situation?
So if the details are not maintained, I mean, then as an auditor, you can't do anything. You will have to make a statement to that effect in the audit report that this is not in line with the requirement of Schedule 3, or you are unable to verify these details. So if you as an auditor are not having the requisite details to carry out the process which are imposed by the regulator, then you will have to make a statement in the audit report in whatever manner you need to make it. So looking into the gravity, you may make a qualification or you may make an emphasis of matter. It all depends.
Okay. Aging of receivables and payables shown or comparative period also.
Yes, comparatives are required to be given for all the disclosures which are required to be given as per the amendment carried out in Schedule 3. So for comparative period also it has to be given.
Okay. Whether ratio analysis is applicable to consolidated financial statements also.
Yes, it is applicable to consolidated financial statement also, but again, there also one need to evaluate if the company, I mean, if the group is having diversified businesses, they will have to evaluate the numerator and denominator, and accordingly they will have to capture that in the CFS.
Okay. Stock and trade receivables data are given as on 15th of March and financials are on 31st of March. So how to give the difference?
So the requirement is as on the end of every quarter. So here, if it is prior to the end of the quarter, then auditor will have to see. I mean, even if it is given as on 15th of March, so then in that case, the auditor will have to see that books mein jo figures are 15th March ko, they are matching with the financial statement or not. So that cutoff has to be taken. The quarter in that case will have to be taken in that sense. So the spirit has to be seen, that spirit has been followed up or not, and if there is any differentiating factor, that disclosure is required to be given in the financial statement.
Okay. Do we need to report if MAT credit was classified as current asset in QIS of Q4 and in audit report it is classified as non-current asset?
What is QIS? Quarterly Information System?
Yes.
Do we need to report if MAT credit was classified as current asset in QIS of Q4 and audit report? I mean, why in audit report? In audit report, there will not be any classification for current or non-current. Sorry, I could not understand this question properly. In fact, if you are able to understand, if you can just throw some light on this.
So maybe request to please throw some more. Seek more clarification in terms of what is the question that you want to ask. It does not affect the drawing part at all, so there is no impact as of here. And I don't think so, sir.
Sorry, I mean, last these two questions I am not able to understand.
Okay.
No problem, Mishra ji. If there's another clarification coming in, just let us know. Otherwise, I think a wonderful session. Amit bhai, lot of takeaways in terms of very critical now. The audit report and the reporting. We've seen a lot of sensitivities around the correct disclosure and correct reporting. I think very well aptly highlighted by you in terms of what all is to be done. So thank you once again. May I request Sharon, if you're there, for a well-deserved word of thanks for the session and for the entire first day of this refresher course. Friends, we've got a wonderful lineup next. Very important topics again, sections highlight, and I'm sure with super faculties lined up again, we'll have a wonderful learning, especially for audits. Should you have any particular questions? Should you have any cases that you would need? I think any of them, all of these faculties would be available and approachable too. So you can write to us at wirc@ici.in, or you would have our numbers. You can WhatsApp us. So probably we could take that in the next session. And email regarding any questions. We'll be happy to take them further up. Mishra ji, any further clarification from the audience? Any other questions?
Yes, sir.
All right. Amit bhai, any final closing comments?
That's fine. Sure, Arpit. Thank you very much. Thank you to you and WIRC for giving this opportunity. And it's always, as usual, a pleasure and honor for me to impart the little knowledge which I have. And I'll be happy to answer any questions if any audience has. Maybe at a later date, they can reach out to you or to me directly. I mean, I'm fine and I'll be happy to answer that. So it's good to see and good to know that WIRC is carrying out these kind of sessions quite regularly. For disseminating knowledge among the audience, the large forum. So thank you very much, Arpit, and wish you the very best for all the future sessions.
Sharon, over to you, please, for a word of thanks for the session.
Yeah. Hello, good evening, one and all. Thanks to WRC of ICAI for giving me an opportunity to present a vote of thanks to our dear member, CA Amit Hundia, sir. Thank you, sir, for giving your deliberation on the disclosures in the financial statements with respect to amendments in Schedule 3, Division 1 and 2. I would appreciate all the members that they were present till the end of the session, and that shows they were very attentive. And at the same time, all the questions were solved by our esteemed member speakers today. So thank you, speakers. And I believe that members had gained some very additional knowledge and that they will implement in their professional work. So thank you, one and all.
Thank you. All right, thank you. Let's declare this session over. Mishra ji, please stop the recording and upload for further viewing on YouTube on WRC channel. I request all the members to please follow us. Should you want to review these sessions again, you can find them on YouTube. Also, we are available across on the Instagram and on Facebook and LinkedIn social media channels. Every update about what WRC is doing, all the activities that we're doing, especially the digital technology initiatives that we've taken to empower our members to make a next big leap in their careers. I think that is data analytics and use of good technology like Python, R, SQL, and Power BI. All of these courses are being provided by WRC. You can please reach out to WRC website or follow any of our handles and social media. You'll find all of us there. Thank you once again. Have a great day. See you again in the next session for this refresher course. Thank you. Bye, sir. Thank you, Amit bhai.
Bye. Yeah.
Thank you, Bhavna ji, and thank you, Sharon, for being there for the entire duration. I'm sure it must be a value add for each of you. Thank you once again.
Surely, sir. Thank you. Thank you so much.
Bye.
Bye-bye.